Minute to go until the start of cash equity trading. I'm Francine Lacqua in London with Tom McKenzie.
And here are your top stories. US core CPI comes in at the hottest level since 1982, with inflation spreading deeper into the economy. A 75 basis point hike next month is all but solidified. Tax U-turn, Liz Truss is said to be preparing to abandon a central part of her plan following weeks of market chaos. Kwasi Kwarteng flies back early from his US trip. And ahead of this weekend's Communist Party Congress in Beijing, we look at how President Xi is securing his plan to stay in power.
Now let's look at the futures, Tom. This is a picture across the board. I mean, what a session we had last week in the U.S. Well, yesterday in the U.S. It feels like last week, but it was only 10 hours ago. The DAX futures getting some 1.5%, and it really goes to show if you're a trader in these kind of volatile markets, you don't really know where to place your bet, especially when you have that hot inflation coming out of the U.S. Because, of course, two interpretations, and we saw that yesterday.
Yeah, absolutely bonkers day on U.S. markets yesterday. At one point, the S&P 500 was down at 2.4%. It ended the session up 2.6%, despite, of course, that red-hot, higher-than-expected inflation print. Is this a bear market rally that we're seeing? And, of course, we have to factor in what's happening here in the UK as the BOE prepares to step away from its bond-buying action. Here's how markets are opening then. The Spanish IBEX getting 1.5%. The FTSE 100 up 76 points, up more than 1%. And the CAC Current gaining 1.5%, picking up the baton then from a very strong session stateside, a very strong session in Asia, and that is reflecting through the European market in the first few seconds. Let's switch it over to our cross-asset board as well and get a sense of how the futures are looking. But before we do that, we'll check in on sterling. A big day, as I said, as the BOE assesses whether it can indeed, as it said it will, walk away from those bond purchases as the Chancellor returns to the UK to work through the mess that is the fiscal plans for this government. The pound currently gaining, look at that, over 2 days, 2%, currently at 113. Will this hold? Let's switch it over now to cross-asset. We're looking, and we want to bring your attention to the action in Asia as well. Currently up 2.5% on the HS Tech, which is those big companies, of course, Hong Kong-listed tech companies. At one point getting 5%, so that rally following through, particularly pronounced within the tech stocks in Hong Kong. The future stateside pointing to build on those gains of yesterday, up 0.6%. The 10-year at 3.89. That's a move lower by 4 basis points on the benchmark yield, 3.89. Brent, $94 a barrel, gaining 0.3%. Let's switch it over and have a look at the gilts then as they open on this important day for UK bond markets. Currently, you're seeing a bid then, a modest bid for UK debt. Currently, 3.59 on the 2-year. That's a move lower by 2 basis points. The 5-year at 4.24. The benchmark at 4, holding at 4, a move lower by a little under 2 basis points. In fact, let me recorrect. In fact, you're seeing a 20 basis point move now, a 22 basis point move on the 5-year, and the benchmark 10-year, 18 basis point move. So these are big moves lower in terms of yields across the yield curve here in the UK. The 30-year, the longer end, of course, 4.38 is what you're looking at here in the UK as we weigh up again. The purchases yesterday, around £4.6 billion of purchases, but again, the prospect that the BO steps away. Francine.
Yeah, I have to say, with these higher interest rates piling pressure on an already struggling economy, it's really difficult to see where traders go. So hopes that the Fed will consider dialing back its aggressive rate hikes have been dashed again by hotter than expected inflation. Core U.S. CPI jumped to a 40-year high of 6.6% year-on-year in September. President Biden acknowledged there's more to do to combat rising prices.
Americans are squeezed by the cost of living. It's been true for years, and folks don't need to report to tell them they're being squeezed. Fighting this battle every day is a key reason why I ran for president of the United States.
Let's unpack all of this now with Bloomberg's Christina Quino and T.S. Lombard's senior global macro strategist, Skylar Montgomery-Koenig. So thank you both for joining us. Christine, you look at the kind of the crazy moves, actually, the wild swings that we had yesterday, and talk to us a little bit about what this means for traders on how you position in this kind of environment.
Well, Francine, I think yesterday's report just drives home the point that there is more work to be done by the Fed in terms of tackling this inflation picture, right? I mean, yesterday, I think the clearest sign that we saw of really the market reaction was in the short end rate space, where traders put those bets back on. It's now, I think we're now pricing 3 consecutive 75 basis point rate hikes over the next few months. And, you know, that narrative kind of came, pulled back a little bit over the last few weeks when people were started to see signs of inflation peaking a little bit from the housing market, a little bit in wages as well, some tightness in the labor market looking to be easing off. But yesterday's number really just kind of pours cold water on that narrative. And I think that is a danger, right? Calling peak inflation, always dangerous.
Redhead crossing the terminal right now. We hit it at the market open, just worth reminding, on a massive day for the debt markets here in the UK. So UK bonds absolutely surging in the first few seconds of the open, the first few minutes. Currently, you're looking at the 10-year. That is a 13 basis point move lower, currently trading at 4.06. The 2-year, that is a 13, almost 14 basis point move lower. And the 30-year trading at 4.43. That's a 12 basis point move lower. So money is moving into these bond markets. Whether this will be sustained, of course, a key question. And we'll get more on the UK situation as well, of course, in the minutes ahead, Francine.
Yeah, so we need to really try and understand what this emergency program ending for the BOE means. And again, you're right. This is just the first couple of minutes where they're opening. So let's see longer term what it means. Skylar, we'll get to the Bank of England, of course, some of the pitfalls for a lot of the pension funds shortly. Overall, what kind of environment are we in?
I mean, we've been in this environment since the beginning of the year where you've had very volatile inflation. Inflation keeps surprising to the upside, so inflation surprises have been positive pretty much across regions throughout this year, and that's meant we keep getting a repricing higher in the terminal rate. And, you know, it's pretty much a one-factor model for a lot of markets right now in terms of a higher terminal rate means you get higher yields, it means you get lower risk assets, and we just keep kind of going through these cycles, and that's what we've seen this week as well. And so, you know, we're in this kind of market where it's very dependent on inflation, it's very dependent thus on the terminal rate, and, you know, you just need to be watching the data closely to trade it as a result.
Skylar, on the, so you know, Christine was pointing out the market's pricing in 3 75 basis point hikes. Remarkable. So you talk about the terminal rate. Do you see that above 4.6% next year? Do 3 75 basis points look reasonable at this point for you?
I mean, I think what the inflation data told you was that demand is still very, very strong. It's very robust. And we've been saying that throughout this year. In terms of gasoline prices, you know, everyone thinks that they feed out of inflation, and they are feeding out of inflation in a mechanical way. The gasoline prices have a very strong correlation to consumer confidence. And so the gasoline prices coming down, that's feeding positively into consumer confidence and means consumers are spending more on goods elsewhere. And this is more of a U.S. problem than it is a problem elsewhere in terms of, you know, U.S. inflation is much more demand-driven than European inflation, which is much more supply-driven. And as a result, the Fed has to do more to damp down on that inflation, because if gasoline prices are coming down, prices are rising somewhere else. And so for us, we think that, you know, we get a pricing of 5.5% in the terminal rate. Our chief U.S. economist, Steve Blitzy, expects that to be 5.5%.
So, Christine, what did we learn actually from the CPI print, apart from the fact that it's a nightmare and we could see actually quite a deep recession ensuing? I know the Fed swaps are leading towards, I think, what, 3 quarter-point hikes back-to-back. I mean, that's aggressive.
That is going to be really aggressive, Francine. I think really the takeaway here is that the hope for a softer landing, or perhaps maybe a short, quick recession, might not be coming to fruition here. I think it really does tilt the balance towards more of a harder landing, which is, you know, part of the narrative that we've been seeing. I think it was Goldman was saying that, you know, it is more likely now after yesterday's print. And yeah, I think that kind of just puts the extremes of of the potential economic outcomes into next year. I mean, I think there was an initial hope that perhaps, the Fed can raise it to that restrictive rate, maybe keep rates at that level and see how that plays out for the economy. But given what we saw yesterday in terms of the CPI print, and then also the potential for the pain that inflicts on the economy and demand, I think we will potentially get that immediate U-turn once we hit that terminal rate, which is currently priced for about March 2023.
Skylar, I want to get your thoughts on the here and now, the markets. You're seeing gains of 1.7% across European stocks. You had the whip soaring yesterday, down 1.24%, gaining by the end of the session 2.6%. How do you characterize this market? Is this a bear market rally that we're seeing?
Yeah, I mean, I think it's really, representation of how the market's trading right now in terms of global tightening. It's occurring on a scale that we've not seen in decades. The central banks are not only hiking in large magnitudes, but they're doing it quickly. At the same time, central bank balance sheets are shrinking and government deficits are increasing. So that means, government supply is increasing while demand is decreasing, and yields are rising on the back of that because of this tightening. And on top of that, you've got this persistent dollar strength, and that's feeding further into that tightening pressure. And all it means is, volatility is rising, and it's rising, and it's going to stay elevated, and that means market fragilities are being exposed. And so yesterday's reaction, I think, is a reflection of, that volatility. And I think, these fragilities, they were built up because we had a decade of perma low rates in QE, and the market saying, there are fragilities from higher rates, and the tightening cycle isn't stopping anytime soon. So I think that means that we're likely to get more accidents like what we saw in the UK. And we're starting to see cracks in the data. So if you look at the OFR's financial stress index, that looks at financial stress through 5 factors: safe assets, credit, volatility, funding, and equity valuations. And while that measure is well below levels consistent with the global crisis, it has risen to a 2-year high. And that's led by higher volatility, particularly rates volatility. And I think we're going to continue to see these kinds of sharp moves as a result.
Yeah, further sharp moves. Hold on to your hats. T.S. Lombard, Skylar Montgomery, Koning is going to stay with us, very pleased to say. Bloomberg's Christina Aquino, thank you for walking us through all the action, particularly on the back of that hotter than expected CPI print. Coming up, U-turn if you want to. Liz Truss is reported to be preparing to abandon a central part of her tax cut plan. We're going to bring you the details. This is Bloomberg.
What do you think of when you think of a battery? For most, it's what we use to power devices for both work and play, and maybe even your car. Over the past few decades, they've gotten way more powerful, long-lasting, and affordable. But all of this is just a prologue to what the next batteries are going to do.
As we drive to an increasingly renewable power-driven grid, we also need to be able to store energy and release it later to cover those periods of weather intermittencies that are driving this new grid that we're in. It's a multi-trillion-dollar opportunity, and it's imperative that we figure out the solution here.
How we store energy on a massive scale is in many ways the central challenge of the fight to stop climate change.
really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Welcome back to the Bloomberg European Open. This is a picture for gilts. Now you can see the 2-year 3.630, the 30-year at 4.437. Now they seem to be showing signs of a recovery after the historic sell-off. Again, that recovery actually started yesterday afternoon, Tom. It's been a week of extreme volatility in bond markets. So if we have a 1-week look at what's been happening for example, the 30-year rate soaring above 5% on Wednesday, it really shows volatility and the whipsawing that we're seeing. So for the moment, a bit of stability. Again, bonds surging at the open. I think I was told yesterday, look, when the markets get very bearish, it doesn't take much to snap back. So let's see what happens in the next couple of hours.
Yeah, and talking about uncertainty, it's uncertainty around the fiscal plans and it's uncertainty about the BOE. Will they indeed continue to buy bonds after today? They've set themselves a deadline. Many in the markets think they'll have to step back in. And what exactly is going to be changed within this fiscal plan from Liz Truss and Quantum?
Yeah, so in what could be a stunning U-turn, the Prime Minister Liz Truss is reported to be preparing to abandon a central part of her tax-cutting agenda after weeks of chaos in the markets. Now, the Chancellor has actually cut short his trip to the U.S. and is heading back to London just hours after insisting he's, quote, not going anywhere.
Our position hasn't changed. I will come up with the medium-term fiscal plan on the 31st of October, as I said earlier in the week, and there'll be more detail there. What I'm totally focused on is on delivering on the mini-budget, making sure that we get growth back into our economy. I'm not going anywhere.
Okay, that was the Chancellor, of course. The Bank of England Governor Andrew Bailey's gamble, ending an emergency bond buying programme today, appears to be paying off. Bloomberg's Lizzie Burden joins us from outside the Bank of England. Lizzie, what was the turning point then from this government?
Well, markets priced in a U-turn yesterday. The pound and gilts rose on reports that we would see a U-turn on the corporation tax freeze, and actually the reports are that Liz Truss and Kwasi Kwarteng will raise corporation tax, perhaps though not as much as Boris Johnson had planned to, from 19% to 25%. But this was a key plank of Trussonomics as part of her efforts to boost growth. So it's a massive U-turn. You've got Kwarteng coming back. It smacks of when the Greek finance minister had to return from the G20 in 2011 to deal with the sovereign debt crisis, although his allies are shunning that comparison. And the question now is, will Truss survive? The Times is reporting today that the Tory party could change its rules and she could be replaced by Rishi Sunak and Penny Mordaunt, who of course ran against her for the leadership. But whoever would replace Truss would have a massively diluted mandate. There would be huge pressure on them to call a snap general election, and by the polls at the moment, it looks like Labour would win that.
Yeah, we also just got some breaking news. The Bank of England reserving the right to boost the size of the final gilt buying operations, Lizzie. So it's the last time, or the last day of this emergency bond buying program. Is it likely that Bailey will need to extend it, or have they bought so much of the stuff right now that we should be fine?
Well, it looks like in the game of chicken between Kwasi Kwarteng and Andrew Bailey's won, and it's Kwarteng who's going to have to do the U-turn. Remember, Kwarteng said that if the market turmoil continued and Andrew Bailey didn't extend this emergency bond buying programme, it would be a matter for the governor. And Bailey, on the other hand, has staked his credibility on holding firm to this deadline. It looks like he's going to get away with that. However, if the market turmoil does continue, perhaps we'll see a more creative solution on how to help pension funds. I was speaking to former BOE policymaker Martin Wheel yesterday. He said there could be targeted help for pension funds. But crucially, Bailey is going to be desperate to not continue with the blunt instrument of quantitative easing, because at the moment it looks like they're prioritising financial stability over inflation fighting and being dominated by fiscal policy. It seems perhaps okay as an emergency measure, but not something to be extended. That's what the IMF's message seemed to be yesterday.
Lizzie, thank you so much. Lizzie Burden there reporting outside the Bank of England for us. Now, T.S. Lombard Senior Global Macro Strategist Skylar Montgomery Koning and Bloomberg's Christina Kino are both still with us. Skylar, do you buy anything in terms of UK assets right now?
I mean, I think the short answer is no. I think the longer answer is obviously there's always a buying opportunity at some point. It depends on whether or not you're a tactical trader or not. But I think when you look at UK assets, and even if we do get this big U-turn, and the U-turn would definitely be a positive in terms of you get a pop up. I think even if we get this U-turn, confidence has been completely shaken, right? And the U-turn doesn't add to that. And I think, I've seen a couple quotes around there that's essentially, they say that, in terms of confidence, it's the elevator down and the stairs back up. So it takes quite a lot to build that confidence. And, structurally, the pound was weakening before we got the mini budget. You had, yields higher globally, and, UK equities have outperformed, but the structural backdrop for the UK is not good. And that's why you saw those asset market performances in those way in terms of, UK growth is slowing. We're headed towards a recession. And there's not a lot that the fiscal authorities can do. And they've certainly done a very poor job of what they have done, but there's not a lot to stop that growth downgrade and that growth recession.
So that massive knock to confidence, and it comes down to credibility. Christine, I want to bring you in at this point. The turnaround that we're seeing in the gilt markets today, and Francine was rightly pointing out the volatility that we've seen, dramatic volatility in the UK bond markets over this week. But does today point to a turning point for UK gilts? Are they managed to cap things now, or is further volatility something we need to be thinking about in the days ahead?
Well, Tom, today the turnaround, I think, in gilts is really the best case scenario for the market in a lot of ways. On the one hand, you have the BOE facility. Yes, it is meant to be ending, but that is meant to be temporary, although Andrew Bailey reserving the right to continue some kind of measure in the future would definitely be calming for investors. And then on the other hand, you have the government U-turning or potentially U-turning on a key part of its fiscal policy, which really was the root cause of the meltdown in the first place. And so, a lot of investors are kind of looking for the scenario where a BOE facility that was always meant to be temporary finally being wound down, and then the onus being put back on the government to essentially reel back the policy that was destructive for markets in the first place.
Do markets need to see that change crystallize? Because for the moment it's speculation, crystallize on Monday. Do they need to see that coming forward early and soon from the UK government, that change in corporation tax?
Yeah, this is a key point, Tom. I think nothing is set in stone at the moment, and so we still need certainty on this potential U-turn. I mean, we could be sitting in a best case scenario right now for markets. Come Monday morning, that could very easily change into worst case scenario if indeed that U-turn does not materialize.
Skylar, at the same time, and we know that there's a backstop to the backstop, right, in terms of buying gilts, and I think it's a backstop through the facilities available to the banks to actually inject liquidity for the pension funds. It rolls off the tongue. It's called the Temporary Expanded Collateral Repo Facility. How much will that help?
I mean, I think what you're seeing generally from the Bank of England and from the government is and this is not just in the UK, it's everywhere, right, in terms of they are backstopping financial stability. And I think, that facility will help quite a lot. But generally, nowhere wants disorderly markets. No one wants financial stability risks with these kind of amplifiers that risk contagion into the real economy and risk contagion into other markets. And so I think, well, we likely get the end of the temporary bond buying program. If we get disorderly markets again, there's no way that the Bank of England can't step in again. And so, we're putting these temporary stopgap kind of Band-Aid measures in place in a lot of countries. And, I think they'll help. But if you get disorderly markets, they have to come back in.
Skylar, very, very quickly, do you hold your short position on the pound?
Yes, and we've actually got it. I mean, we like it versus safe havens generally, but yes, we still have one since kind of November of last year.
Skylar, fantastic insights. Thank you. Happy Friday. Have a great weekend. Skylar Montgomery-Koning, Senior Global Macro Strategist at TS Lombard, and of course, Bloomberg's Christine Aquino. Coming up, China's Communist Party Congress begins Sunday with Xi Jinping expected to secure a record-breaking third term. We'll get the details. This is Bloomberg.
digital-first approach to the future of work is where the industry and all companies will be heading.
Could the future of work not be at home or in the office, but in the metaverse instead?
There's that word, metaverse.
Doing well. How are you doing?
When I think about the metaverse, I think about immersive experiences that have a sense of active presence.
Wow, look at this. This is me. The metaverse is projected to become over $1 trillion market by the end of this decade. And whether you know it or not, you'll probably be working there in the future.
We're moving into a world where we're going to be interacting with computers with our bodies.
This is definitely trippy.
I think the adoption curve is going to be slow.
It's weird.
Like a weird floaty thing right now.
Oh, look at you. You have no legs.
It's kind of a fun world, and we're just at the very beginning of a very long journey.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Let's get straight to the Bloomberg Business Flash. Here's Alice Atkins. Hi, Alice.
Hi, Francine. BlackRock's assets under management dropped 16% in the third quarter to the lowest level since 2020. That left the world's biggest asset manager overseeing just under $8 trillion. Investors pulled money from several BlackRock offerings, including equities and cash management, as central banks hiked rates. Core products attracted $65 billion of net inflows, missing estimates. Bloomberg has learned that Mizuho Financial Group has emerged as a suitor for part of Credit Suisse's securitized products group. Sources say the Japanese bank is competing against interest from Apollo Global and PIMCO and others. Credit Suisse says the platform, which employs about $20 billion in risk-weighted assets, is highly profitable. And Bloomberg has learned that Kroger is in tie-up talks with rival Albertsons, a move that could create a U.S. supermarket giant. Sources say a cash and stock deal could value Albertsons at about $25 billion. According to data from Numerator, Kroger is the #2 grocery player in the U.S., while Albertsons is 4th. That's your Bloomberg Business Flash. Tom, Francine.
Alice Atkins here in London. Thank you very much indeed. Just briefly checking on the markets then. You're seeing gains across the European benchmark. Stock 600 gains of 1.2%. The sectors standing out at the moment. Real estate, basic resources and chemicals all gaining around 2%. And in terms of your bond markets, gilts continue to be bid, though less. That is coming off that bid slightly from the open. You see some yield move of 12 basis points at the front end, currently at 3.67, but again, less pronounced than about 10, 15 minutes ago. The 10-year at 4.11, that is a move lower by 8 basis points. Again, the Bank of England could be looking to buy around £5 billion worth of additional gilts in its final day of operations, of course. Will they be forced to extend? Coming up, pricing in a fiscal U-turn. UK bonds are surging this morning, as we mentioned. The Bank of England's intervention set to end in just a matter of hours. This is Bloomberg.
My grandfather got into the mutual fund business because the average investor could not get a diversified stock portfolio, and it was too dangerous to put, your entire savings in just a couple of companies. So the mutual fund was created to give a diversified expert management at a reasonable price. Today, we have a phenomenon where companies are waiting much longer to go public. And so in 2000, the average company went public after 3 years. Now, companies are waiting 9 to 10 years because there's so much money available in the private markets. As a matter of fact, there are half the number of public companies that there were in 2000, and there's 5 times the number of private equity-backed companies. So just from an investable universe, you look at the private markets, and it's significantly bigger. So the question is, that return that used to be captured in the public markets is now captured in the private markets. But the problem, as you know, is you're really tied up for a long time when you invest in a private equity fund. And so trying to figure out a way to solve the same problem my grandfather was trying to solve, which is how do you bring those returns responsibly, the democratization of the private markets to the retail investors. And I describe it as a bit of like running with scissors. Scissors is a great tool if you use it appropriately. And so we're focused on trying to figure out responsibly bringing it in to the average investor.
You will shed light on dark matter. You will make aging optional. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
Welcome back to the Open, everyone. 30 minutes into the European trading day, and here are your top stories. Risk on returns. European stocks surge at the Open, extending the remarkable rebound that began yesterday on Wall Street, while gilt yields slide on bet that the UK government will cancel plans for large tax cuts. Fiscal U-turn, while Liz Truss is said to be preparing to abandon this central part of her plan following weeks of market chaos. Kwasi Kwarteng, the Chancellor, flies back early from his U.S. trip. U.S. core CPI comes in at the hottest level since 1982, with inflation spreading deeper into the economy. A 75 basis point hike next month is all but solidified. But then, Tom, you look at the markets, and of course, they kind of seem to, defy this rates outlook and the gloom out there on the economy.
Yeah, it's remarkable, the action in the markets, given that hotter than expected CPI print out of the US. And expectations, we were talking with Christina Kino from Bloomberg earlier, about 3 75 basis point hikes from the Fed going forward from November through the months ahead, of course. But despite that, you did see a rally that some are characterizing maybe as a bear market rally, maybe are washing out some of the short positions. Maybe there's some technical factors at play. Everyone trying to work out what is going on in terms of the optimism, the enthusiasm in these markets, and whether it's going to be short-lived. That is the sense, of course, from many out there. The bear market rally, is that what we're looking at? Gains of a little over 1% across the benchmark. Over in Germany, the DAX up 113 points. And the FTSE 100 here in the UK up 0.9%. The Chancellor, of course, hot-footing it back from DC to London to work through those fiscal plans. And, of course, we watch any lines that come out on the back of that, given the reporting yesterday on this potential U-turn, particularly around the corporation tax, and to what extent that will assuage the markets. The Bank of England, of course, expected to end its bond purchases later today, so expect them to play a heavy role in these markets until that deadline is hit. Switch it over and see how things are playing out across these sectors then. The last time I looked, every one was in the green. That remains the case. Real estate, basic resources and chemicals all up around 2%. At the bottom of the list, but still in the green, up 0.6%, is autos and parts retail as well. So still, the music is positive following very strong sessions in the US, in Asia overnight as well, and now carrying on into the European markets. But will it be sustained? And to what extent will the moves of money into gilts continue as well? Because the yields have dropped, but not as much as at the start of the session. Some of that is being paired, so suggesting again that there's going to be volatility until we get more clarity on those fiscal plans and the BOE's role. Francine.
Yeah, I wonder how much the BOE is buying right now. Now, China's Communist Party Congress begins this weekend with a host of challenges facing the nation's leadership.
I think the longer-term picture in China is still bright, because I know the people and I know the culture, and I think it's good, but they have major issues now.
We do not seek a Cold War. We do not ask any nation to choose between the United States or any other partner. But the United States will be unabashed in promoting our vision of a free, open, secure, and prosperous world.
This is not a time to create fresh ruptures, to create fresh Cold Wars between the United States and China.
We have our scenario planning, obviously. We all hope that there is no increasing conflict on Taiwan.
Despite of all the geopolitical things that are going, it's still a very attractive market.
If China's economy continues to slow, the way we are seeing, that will have a big impact on what happens to the world economy.
You've got the number 2 economy that's not really jumping forward.
Now, to dive deeper into all of this, let's bring in Bloomberg's Rebecca Chung-Wilkins. Rebecca, thank you so much for joining us. So the People's Congress starts on Sunday. What kind of language should we be watching for in the speech?
Absolutely. Well, these speeches do tend to be stressing continuity, and we do have to approach them with a little bit of humility. It's typically quite difficult to actually trade these sort of political events themselves, but we are looking for this key language around just how Xi Jinping plans to balance risk and security against development, and what he might tout as successes in Beijing's shift to focus more on the quality of growth rather than quantity for itself. And both of those things will provide some sense of direction for future policy.
And Rebecca, you and the team have documented so well over the last few months and years. Of course, a number of these policies from the Xi Jinping team have been damaging across real estate or technology and an impact across markets. Is there anything that we can look for in terms of the markets, in terms of an uplift from the Congress that we may have seen in the past?
Absolutely, Tom. Well, we have seen this sort of more ideological shift driving, for example, some of these crackdowns on tech and property, as you say. And I think, there is actually quite a strong mood of pessimism that has entered the markets. If you just take a look, it's very, very unusual to see markets perform this badly. The CSI, one of the worst performers in the world, the UN near record lows, offshore credit in the junk space at record lows as well. It is really quite unusual. So some bright spots potentially around green, EV, and the shift to sort of environmental and green transition. That might be one area to look at. And of course, the other area, really not necessarily a bright spot, but one area that's being monitored very closely is what happens with Taiwan. If there's any indication of an explicit timeline or an accelerated timeline for unification there.
Rebecca, how are they dealing with COVID? I don't know whether we continue with the zero COVID policy going into 2023 or whether, they're trying to actually get other vaccines that work better and free up the people a bit more.
Well, there was some optimism just a few weeks back that there would be relief for COVID-0, but of course we see cases rising in Shanghai. And one important indicator on passing future policy and what Xi Jinping says is to look at state media. And if you take a look at what we've seen over the last week, more and more of these big editorials in state publications making it clear that COVID-0 very much here to stay for now. And we have these sort of big political voices making statements in the media reinforcing that despite the economic costs, COVID-0 is still the way to go.
Okay, Bloomberg's Rebecca Chung-Wilkins looking ahead to that important party congress that kicks off in Beijing on Sunday. Thank you. Let's check back in on UK assets then, of course, on this crucial day, particularly for the bond markets. But I'll kick off with the pound first of all. 112 on sterling. That's a move lower by 0.6%. Bonds, gilts are still bid, but yields are down, but not as much as they were. It's more exaggerated at the front end. So you've got a 12 basis point move lower on the 2-year at 367. The 30-year, 449. That is a move lower by around 5 basis points. Francine.
So let's get back to the UK. We are looking at the gilts. We're looking at what this U-turn could mean for pound. The Prime Minister, Liz Truss, is reportedly preparing to abandon a central part of her tax-cutting agenda after weeks of chaos in the markets. Let's bring in Bloomberg Opinions. Marcus Ashworth. Marcus, always great to speak to you. I'm looking at what you wrote this morning, which was, funny as always, smart as always, and you basically said the BOE made a massive gamble and looks like they could be winning this.
Well, as the old saying is, it's better to be lucky than clever, and certainly I think Bailey must be feeling he's won the political battle with the government here. Clearly, what the Bank of England has done with not changing its plans on QT, as clearly people had been hoping, It looks like the debt management office has got out the Bank of England's way. That's the Treasury moving for the central bank, and normally it should be the other way around. But clearly, the Bank of England is got one last day to get its acting together. I suspect there's a chance they may increase the size they buy today. Certainly, yesterday was quite surprising into the index-linked part of the buyback. They bought an awful lot more than people expected because it was supposed to be set to Monday's close, but they paid far higher for it than people had expected, much larger size, and I clearly think they want to get on with it. Put an end to this particular buyback, but they've got a lot of other stuff they've introduced, particularly on the repo side, to get rid of this collateral squeeze nightmare we saw at the beginning of this 3-week crisis. And possibly they may introduce something new. I think that's the way around it. And at the last bit, they've always got the ability to restart this program and carry that sort of big stick behind their back if needed to keep the gilt market perhaps under a bit more control when it's shown.
Keeping the big stick behind their back. Of course, linking inevitably to the politics of all of this, Marcus, is a cut to the UK corporation tax, or in fact the increase. They're going to reverse the cut. Is that really going to be enough to assuage these markets? Even if they go full hog on UK corporation tax, you're still looking at about a £40 billion hole in UK spending that needs to be addressed.
Well, it's hard to separate the politics away from a simple dynamic that the Bank of England is buying a lot of bonds in. So, trying to separate the two is not easy. But I don't think it doesn't necessarily matter which bit gets changed. It's just that it is an element of the OBR which marks the government's homework, hands back a pass. And that's all. However, the numbers are moved around is not necessarily relevant. It's just they want to see the prospect of unfunded tax cuts moved away. There's a lot more supply coming over the next year or two in the gilt market. It can be handled. You don't really need the Bank of England actively selling QT just now. That would be great if they could delay that. But nonetheless, there are some positive dynamics in the next few months with regards to supply, which could see things settle down a bit. Let's hope.
Yeah, but nobody wants to own gilts at the moment, and the government needs to issue a lot more of them. Who's a natural buyer if the pension funds don't step in?
Well, I think some people do want to buy gilts, Francine, and in the context of yields are much higher. And in fact, they've stepped out of line with the rest of the world, and I would expect they will come back into line. Of course, it's all about what the US Treasury does. And I think we saw a reaction after CPI yesterday that perhaps people still are expecting this Fed pivot after a hike, probably of 75, both the Bank of England and the Fed early next month. But there is a hope that there is more sort of relief going to come on that. I think gilts at the long end look cheap. And if things can settle down, I think that there will be buyers. Foreigners, certainly with sterling this low, could be tempted back. But we've got to get our homework done and presented and passed with a big tick from the OBR first.
Do you see how he did that? I'm in the Ashworth doghouse for suggesting people didn't want to buy gilts.
How'd you get out of the doghouse now, Francine?
I'll bring donuts, Marcus.
There you go, Marcus Ashworth, always brilliant. I was going to say putting Francine in her place. That sounds a bit wrong, doesn't it? But maybe Marcus is the one snapping up these bonds. At the long end, that's where he says the opportunity is. Maybe. Thank you, Marcus Ashworth of Bloomberg Opinion. Of course, you can check out his opinion pieces on the terminal and on Bloomberg.com. Let's get to our next guest then. At least we'll tease our next guest. We're going to be joined by the CEO of 91, Hendrik de Toit. We're going to talk markets and how the biggest climate finance alliance could be falling apart ahead of next month's COP27 in Egypt. This is a fund with about $150 billion assets under management. So stay tuned. This is Bloomberg.
There is an epic saying in Italy when it comes comes to family generations, that the first generation creates, the second generation expands, and the third generation destroys. And that's almost what happened in the Gucci story.
So hate and love together.
Now I would have a much more experience about those who says I love you and then betrayed you.
The Gucci family was the strength, but also the weakness of the label.
The situation became dire with Gucci's finances. They were not able to pay salaries. They were not able to pay suppliers. Gucci's really teetering on the brink at this stage.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
I don't know if it could be a soft landing. I don't think so, but it might. Mild recession or tough recession. My point in the tough recession, yeah, you would expect the market at another 20 or 30%. I'm not going to give odds across those three things, but for all of us who have to worry about risk, yeah, of course you should plan for those things.
JP Morgan CEO, of course, Jamie Dimon, who is not optimistic about a US recession being avoided. He spoke as CPI came in hotter than expected, all but cementing a 75 basis point hike from the Fed next month.
Now, to discuss how this will impact global markets, we're joined by the chief executive of 91, Hendrik de Toit. Hendrik, thank you so much for joining us. Were you like hiding under your desk in extreme volatility over the last 2 weeks? I can't imagine what it's like actually being, the head of a big asset management company where there's like all this stuff going on.
Good morning, Francine and Tom. I think you've got two things going on. You have a proper bear market for fundamental reasons. Then you have this artificial situation in the UK caused by essentially a kind of a financial structure that was created by the pension funds. And on top of that, you had a government that's, to say the least, has limited credibility. And so if you operate in the UK markets, you've got more than one issue to deal with. If you operate around the world, there is a general risk-off market, which makes life difficult for long asset managers. Even though we have a long-term horizon, people look at the value of their investments.
And then there's a view, the central banks keep going until either there's a recession or something breaks. What comes first?
Well, our view is clearly that central banks will keep going this time because they were behind the curve last time. And actually, you can see some of the more stable, and we do quite a lot in emerging markets, some of the more stable places in the world actually are the places which hiked early, dealt with the issue, and are kind of having a relative stability. So I think we're still going to see erring on the high side, not the low side, because in the end, Jerome Powell has read history, and he doesn't want to be Arthur Burns.
I find you very optimistic. I don't know what part of the world actually has dealt with this.
No, I'm not optimistic. I'm just saying the countries that have addressed and the ones that have hiked early, and South Africa, where I come from, is one where currency's been absolutely stable, external balances have been stable, in spite of issues there, because the central bank governor was ahead of the curve, not behind the curve. So you see that differentiation in the world, and I don't think this is going to end, and therefore you've got to stay ahead.
I mean, we wanted to expand it, but you got to the UK as well pretty early in this conversation, so we'll go there.
I didn't want to get there, Tom.
No, you did. You absolutely did. You had a glint in your eye when we talked about the UK, and you talked to us a little bit in the break. Are you buying anything in the UK? Any assets looking attractive to you amid all this turmoil that we're seeing?
I mean, we have UK-dedicated mandates But is the UK, UK has been perennially cheap market, not in the fixed income side, but in the equity side for a long time because of structural reasons. The situation in the pension market has just pointed or put a spotlight on those structural reasons, that there isn't a long-term risk pool in the UK because you thought you could de-risk and then use derivatives and leverage something like a pension fund, which I think needs to be addressed.
So what, they become much safer like the US, but do you also have this underlying problem of U-turns and unfunded tax cuts and the relationship with the Bank of England?
That is just that's what caused it, that's the symptom, and that's an issue in itself. But I think in terms of the UK at the moment, the challenge long-term for UK capital markets is, can it keep its own pool of risk capital to behave like a pool of risk capital which is taking the counter? Now, if you've taken banks, if you made banks too safe, they're not going to come in and buy at scale. Jamie Dimon's got a balance sheet of $1.5 trillion. He could have absorbed that 65 billion in no time. But there's regulatory constraint on him. On the other hand, the pension system has been essentially neutered by this LDI story to say, okay, I can take all risk out. You cannot take risk out. Every country, every economy needs a long-term savings pool willing to take risk. And to use Mark Carney's phrase, the UK remains at the mercy or dependent on the kindness of strangers, which makes it a vulnerable, and therefore you lead to something ex-US, which one of my colleagues coined earlier this week, and I thought was quite good. He talked about the EMification of DM. Where do you get U-turns now? DM, developed market policy. Where do you get capital flows in and out, upsetting markets? Developed markets ex-US. So I think we're in a very interesting, volatile, challenging world.
Just briefly, what is the tactical trade at the moment for you?
I mean, I guess tactical trade, everyone's relief. 10 years will probably do okay for a while. But in the end, if you look, and I'm in the structural game. We invest money for the very long term. Is this the end of the bond or the fixed income bear market? No. I'd rather go to credit and EMs where I can pick up higher, more distressed yields in the near term than a few basis points in a developed market, which is uncertain.
All right, Hendrik, don't go anywhere. Hendrik de Toit there, the chief executive of 91, stays with us. We'll talk all about dollar strength and actually what that does to some of the emerging markets. We'll also pivot to ESG. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
We will never break.
So GFANZ is a huge alliance of more than 500 financial entities publicly committed to reaching net zero carbon emissions by the middle of the century. It was widely celebrated at last year's COP26, but now Bloomberg understands some major banks have tried to ditch the alliance ahead of COP27 in Egypt next month. GFANZ is co-chaired by Michael Bloomberg, the founder of Bloomberg LP, and of course, we call it the Carney shop. So this was the former Bank of England. I don't know what job is harder, whether to harangue asset managers to be part of this or in charge of the Bank of England right now. 91 is a member of GFANZ, and the chief executive, Hendrik du Toit, is still with us. Hendrik, when you look at GFANZ, and we had a conversation actually in New York 2 weeks ago with Mark Carney on this, he was pushing back against the idea that asset managers are less committed to this, but if some of the regulators make it too hard for them, then they could slip away.
Francine, I think the challenge at the moment is coming from two areas: political, US politics, and then independent from the politics is the regulatory challenge, where regulators are starting to put down their own markers and making it quite difficult because they seem to be driving towards a perfect world. And I must say, I must put my cards on the table. I'm on the advisory board of GFANZ for Africa. 91's an active participant. And I think Michael Bloomberg, Mark Carney, Mary Shapiro are doing, Nigel Topping, all these people doing a fantastic job. And what they've done is moved the dial. It is mainstream finance or mainstream in finance to debate whether you are part of net zero or not. That wasn't the case. So let's just look at the gain. Now we're dealing with the difficulty of regulatory framing around it. And I think we just have to have a very honest conversation with regulators that perfect shouldn't be the enemy of the good. The reason why people are withdrawing is not because they're climate skeptics. It's because they're worried about the regulatory implications of being found wanting rather than whether the world is a better place in 2050 or not.
It's the litigation risks.
Exactly.
Right?
Litigation and regulatory pursuit.
Okay.
So it's both. And that's why I say two issues. Okay. The litigation is very much a US issue. But what about the litigation if you've held a whole lot of emitters and they found to be, the externality of emitting is priced in 2040, 50, and they become worthless. Think of BP when it was part of that big oil spill and Obama administration fined it at the size of its market cap. That could happen.
Andrew, I mean, bottom line, and we also have Jamie Dimon saying, look, we're not going to see a soft landing. It feels like the world could come to an end. What does it mean for the commitment of money, big money, into ESG?
If you have a busy week at the office and life is terrible, do you stop thinking about your children's future and their homework and their things to do because your kids one day must be able to be productive citizens? It's exactly the same thing in this. We must think both ways. We must deal with a recession, throw costs overboard, but we cannot ignore that date, 2050. Yeah. And so...
Hendrik, unfortunately, we've run short of time. We're about 15 seconds away from the hard break. But thank you very much, as ever, of course. Hendrik du Toit, CEO of 91. We're going to leave you with what's happening in the gilt markets on this big day for the BOE and the bond markets here. Yields lower by 20 basis points on the 2-year. On the 30-year, you're seeing 13 basis points move lower. Gilts are still bid as we head up to this deadline. Stay with us. This is Bloomberg.
more activity in the fusion world than ever, and not just in government research labs. There's also an emerging private fusion industry that's attracted billions of dollars in capital in recent years.
Governments and private investors alike realise that we've got to find a solution that's going to allow us to get to net zero targets.
This is one of the hardest but most rewarding problems that humanity could work on. Ultimately, we all want the same thing. We want someone to put electricity on the grid from a fusion power station as quickly as possible.
Frankly, the scale of the challenge, 3,000 gigawatts of fossil fuel to replace, there's not many things that can do that. In fact, there may only be fusion that can really do that.
And while many in the scientific community predict fusion power will take decades, some in the private fusion space believe we'll get there in just a few years, as soon as the 2030s.
When U.S. inflation numbers are released,
the score is inflation one fed nothing today.
Bloomberg brings you crucial data at terminal speed.
Core CPI in America, 40-year high.
Yields are absolutely flying.
Equities down and down hard.
It's ugly.
And instant expert analysis.
What is the makeup of this inflation?
We are watching the underlying fundamentals.
Will they go 100 basis points?
The downshift just keeps getting pushed out. Now it looks like we're going into extra innings.
Nobody covers the economy like Bloomberg, your global business authority.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Here's what's coming up on today's program. Gilts surge on expectations that the UK government is preparing for a tax cut U-turn. Kwasi Kwarteng flies back early from his US trip. U.S. core CPI comes in at the hottest level since 1982, with inflation spreading deeper into the economy. A 75 basis point hike next month is all but solidified. And ahead of this weekend's Communist Party Congress in Beijing, we look at how President Xi is securing his plan to stay in power. Now, first thing is first, so let's check on the markets, and I think we're starting with gilts. Of course, this is a momentous day, not only because the Chancellor had to fly back early from those IMF meetings, with the Times reporting that we could actually see a U-turn, or they're thinking about announcing a U-turn on some of the tax cuts and other fiscal plans as soon as today. But today is BOE emergency bond buying ending day. Happy Friday, everyone. You can see that playing out on the market since yesterday when we heard about that U-turn. Remember, for the last 2 days, the Bank of England has been scooping up and buying back gilts. My question of the day is, who is buying UK gilts now? A lot of people won't. I think we have one guest in the studio that actually is, so we'll get to Rupert Harrison shortly. The UK 2-year yield, 3.594. You see on the longer end, 30-year, 4.411. Now, it's quite extraordinary what's happening in markets overall. So let's look not only at the European stocks, but what's happening, I think, in futures over in the U.S., gaining 0.2%. European stocks 1.1% higher. Again, yesterday we saw a massive whipsawing of a lot of these equities. Today, extending this rebound that we saw U.S. stocks roaring back from losses sparked by a hot inflation reading. It is quite difficult to position yourself if you're a trader with all of these quick moves, and then sterling 112.94. So in what could be a stunning U-turn, the Prime Minister, Liz Truss, is reported to be preparing to abandon a central part of her tax-cutting agenda after weeks of chaos in the markets. Now, the Chancellor has cut short his trip to the U.S. He's heading back to London just hours after insisting he's not going anywhere.
Our position hasn't changed. I will come up with the medium-term fiscal plan on the 31st of October, as I said earlier in the week, and there'll be more detail there. What I'm totally focused on is on delivering on the mini-budget, making sure that we get growth back into our economy. I'm not going anywhere.
And so the Bank of England Governor Andrew Bailey's gamble, ending an emergency bond buying program today, appears to be paying off, although things could actually turn quite quickly. Now, we're now joined by Andrew Sentence, Senior Advisor to Cambridge Econometrics, former member of the Bank of England's Monetary Policy Committee, and Rupert Harrison, Portfolio Manager for Multi-Asset Strategies at BlackRock, former Chief of Staff to George Osborne. So I feel like we're replicating. We have the Treasury, former Treasury, and former Bank of England. So thank you both for joining us. When you look at the big concern out there, of course, is the big gamble, which I have to say, Andrew, is one of, I guess, the most powerful but risky moves that any central bank has done, saying in 3 days, that's it, we no longer buy it. We don't no longer, buy gilts. We're not extending that program. Was it right because we're seeing a reversal from fiscal?
Well, there are two things the Bank of England has been doing. One is this intervention in the market, which actually hasn't needed to be as dramatic as they suggested. They haven't used the bulk of the £65 billion that they were committing. But there will still be in place until early November a repo facility, which financial institutions have access to. And so there is a sort of backstop in that respect.
So, Rupert, what is the plan you imagine will come out, actually, from Liz Truss and her team?
Well, look, at the moment, this is all speculation, so we don't know. But it does seem pretty clear the government is preparing a U-turn on at least a very big chunk, if not something like half, of the permanent tax cuts that were in the mini-budget. And certainly if we now, I think, don't get that U-turn, then I think markets will react very negatively, because we're already seeing that starting to be priced in, first yesterday when the rumours broke, and then this morning when it was confirmed that Kwasi Kwarteng was flying back from Washington. I think that markets are looking for something that is, as I say, on the order of at least half of what was done. That may not totally solve the problem, but I think as you're seeing from market moves, I think it will certainly buy time to the 31st of October.
Do you think Liz Truss is safe?
Well, predicting British politics from month to month at the moment is a little bit difficult. I certainly think that this is the wise move for the government, both on an economic and political front. I think given the situation they're in, acting early to stem the bleeding in markets, regain some stability, definitely buys them some time. And I think that's the best she can hope for at the moment.
So, Andrew, what do you think happens next? If we have a big U-turn along the lines of what's being leaked, or at least what's being sourced by the media, is it enough to get credibility back for the UK?
Well, I think what people will be really looking for is a comprehensive statement of the outlook for the economy and the public finances, and that's what was lacking with this mini-budget. Now, that's now scheduled for the 31st of October, so that's still a couple of weeks away. So I think we're going to face a period of continued volatility. There may be some backtracking, as Rupert says, on some of these tax reductions, and that's probably going to be a wise thing.
They can't wait 2 weeks, can they?
Well, that's the schedule we've got at the moment, so we'll have to see. Maybe we'll see some sort of interim measures, as I say, perhaps postponing or reversing some of these tax reductions.
Rupert, do you worry about Treasury not having the expertise for markets, given the departures of Scholar and others?
No, I don't think the Treasury's expertise or the Bank of England's expertise depends on one single person. I think it's certainly a loss to the Treasury to lose Tom Scholar, but James Bowler, who's the new Permanent Secretary, is very, very competent. And I think that the institutions still have a very clear view of what's happening in markets. In the end now, this comes down to the decisions for the politicians.
Okay, so you're not a markets guy and you're buying gilts.
Yeah, we have been buying gilts in the sense that we've been closing what has been a very long-standing underweight. We felt for a long time that the inflation problems in the UK and the policy mix in the UK was not a good combination for gilts. I do think that there is a possibility now, if we do get a U-turn and a little bit of stability, that what has been a kind of negative reinforcing dynamic could turn into a positive reinforcing dynamic. If we get gilts, down off the highs, there are many funds out there that are probably underexposed now to gilts that may need to buy back into a rising market, in a sense, a sort of milder version of some of the negative dynamics we saw before. Of course, it's not the end of the story, and I'm sure Andrew's right that we will see continued volatility. I think the 31st of October remains a very, very important date, because that's when you get the forecast, that's when we get a little bit more clarity into the size of the problem. But I think what we've seen over the last few days is enough to buy time to that event.
Andrew, what are some of the questions that you're asking right now? So do we need to reform actually how pensions work?
I'm not so sure about that. I think the issues with pension funds are really being driven by the speed with which the markets have moved, which wasn't anticipated. I think they were expecting bond yields to go up, but not so dramatically. And that's what's caused the market turmoil, as I understand it. I think we need to think about the way in which monetary and fiscal policy is coordinated in the UK. We have an independent central bank, which is the right thing. But what's caused a lot of this turmoil is that fiscal policy appeared to be pulling in one direction, and monetary policy was pulling in the other direction. And therefore that means that the risk was that the stimulus that was coming from the fiscal side would actually prove inflationary rather than stimulating growth.
But Andrew, so if you see, but this also comes from some of the belligerent talk that Liz Truss had done in her campaign. I mean, once markets stabilize, and I don't know whether you're expecting that in the next 2 to 3 weeks, are we going to see the Bank of England and, you know, the government much more hand in hand like we had in previous crises?
Well, I think we're going to see quite a big increase in interest rates from the Bank of England at the beginning of November. I would say either 0.75% or 1 full percentage point, because they've got a bit behind the curve in terms of controlling inflation. I think my advice for the fiscal side of the account is to prepare the ground much better. I think Liz Truss has acknowledged this already, but to come out so quickly with such a major fiscal announcement with so little backup is what's really caused this problem. So we need more time for fiscal changes to be announced and to be considered before they're announced or before they're put into the public domain.
And how quickly can that happen? So if you're trying to regain market credibility, and you know, there was questions on whether, for example, the assumption for the OBR is a 2.5% growth, which would be very different to what we have right now. But in general, you know, investors that may not be that familiar with the UK, how long does it take for them to say, okay, I'm confident that we're back?
Well, I think there's going to be a risk premium built into UK assets for some time. It's not going to suddenly disappear. But I think that investors can see the government changing tack. As Andrew's saying, I think they're now saying, okay, they are, you know, there's clear respect for the independent institutions, for the bank, for the OBR. We're going to get an independent forecast for the public finances from the OBR. They are not going to take that 2.5% growth as you know, an input. They may show a scenario, but their central case will be their central case. I think the key is going to be that even if we do get a U-turn now, we're talking about, you know, the numbers that are being discussed are sort of 20 billion plus. That still leaves a gap. And so I think there will be a lot of focus on the 31st of October about the credibility of the other measures to close that gap. I think we'll see a combination of spending cuts and maybe some other tax measures on the 31st. And then I think the ideal scenario for the UK government and for UK markets is that after the 31st, we're in a sort of political row about those rather than a markets row about the credibility.
But, so Rupert, the U-turn, you think, you know, is a U-turn on everything? Because we've also heard some fighting talks over the, you know, the last like 24, 48 hours.
Yeah, sure. I mean, so the thing about political environments like this is that the policy is the policy until it changes. Right. So an official spokesperson at the moment has to say we're sticking to the mini budget, but it's pretty clear now that we are going to get some significant changes. I don't think it's going to be the whole package, certainly not right now.
Okay, thank you both. Andrew Senton, Senior Advisor to Cambridge Econometrics, Rupert Harrison, Portfolio Manager at BlackRock. Both stay with us. We'll talk about the Fed and the wider world next. Coming up, another hot month. U.S. CPI for September rises more than expected. We discuss what that means for the Fed and the outlook for the U.S. economy. That's coming up next, and this is Bloomberg.
What do you think of when you think of a battery? For most, it's what we use to power devices for both work and play, and maybe even your car. Over the past few decades, they've gotten way more powerful, long-lasting, and affordable. But all of this is just a prologue to what the next batteries are going to do.
As we drive to an increasingly renewable power-driven grid, we also need to be able to store energy and release it later to cover those periods of weather intermittencies that are driving this new grid that we're in. It's a multi-trillion-dollar opportunity, and it's imperative that we figure out the solution here.
How we store energy on a massive scale is in many ways the central challenge of the fight to stop climate change.
No one covers the world like Bloomberg.
The pressure cooker just got far too hot in Birmingham for the government to handle.
You foresee 2/3 of the crypto hedge funds will disappear. Are we close?
The European Union will support and defend Ukraine's territorial integrity.
With unmatched reach and resources from more than 120 countries, the moment news breaks 24 hours a day. Bloomberg, your global business authority.
I don't know if it could be a soft landing. I don't think so, but it might. Mild recession or a tough recession. My point in the tough recession, yeah, you would expect the market another 20 or 30%. I'm not going to give odds across those three things, but for all of us who have to worry about risk, yeah, of course you should plan for those things.
JP Morgan Chief Executive there, Jamie Dimon, who is not optimistic about recession being avoided. Now, he spoke as U.S. CPI came in hotter than expected, all but cementing a 75 basis point hike from the Fed next month. Now, overall, of course, the picture is exactly on what we've been talking about, inflation, what it means for markets, and how do central banks deal with it. We're back with Andrew Sentence, Senior Advisor to Cambridge Econometrics, Rupert Harrison, Portfolio Manager at BlackRock. Now, that export price index, Andrew was actually asking exactly the figure, year on year, 9.3% for the month of September, and the import price was 6.2% in the U.S. year on year. So we're back with both to try and have a conversation on inflation. Rupert, if you're a world leader, or if you're like central bank around the world, do you look at the UK and do you reassess your plans for budgets?
I think that the message has gone out that you need to be very, very careful about taking market stability for granted. I think that's very, very clear. I think that applies most in Europe, where you've seen quite a big debate in response to big German fiscal plans, where obviously that has big implications for countries with less fiscal space like Italy, and I think that's driving these discussions around more common debt issuance at the European level. But certainly, I think everyone looking at the UK will say, I don't want to be in that situation. More broadly, I think that it has highlighted this issue that when you have rapid rises in interest rates after a period of very, very low rates, you do uncover vulnerabilities. And so I think a lot of investors are thinking, okay, where is the next vulnerability that is going to be uncovered by this kind of rising tide?
But are regulators on top of that?
Well, look, we hope so. I mean, you have to say that actually the UK authorities have dealt with the issue in the UK pretty well. I think the Bank of England has acted swiftly and effectively. So in this case, hopefully no lasting damage has been done. But look, of course, there's always an uncertainty.
Where do you see the biggest vulnerabilities, Andrew? I mean, we spoke to Sir Howard Davies of NatWest, and he was saying exactly the same thing, is that it's once, the rapid rise in interest rates basically leaves swimmers naked. So, so what was the expression?
When the tide goes out, you find out who's been swimming naked, I think.
There you go.
The phrase.
Who has been swimming naked?
Well, I can't comment on the financial market specifically, but I do think we've still got quite a serious problem of inflation. And that's picked up in a way that we haven't seen for 40 years or so. Inflation is nearly 10% here in the UK. It may yet go higher. It depends on how the energy price package that the government's announced kicks in. But the other worrying issue for inflation control is that a big spike in inflation like this is pushing up wages and pushing up other costs in the economy. And so we may see second round effects and a sort of continued above target inflation for quite some time. So I think that's one of the things that we need to focus on.
So what should we be wary of? I mean, shadow banking is something that's also been increasing in the US and in Europe. Is that where we could see a black swan event?
Well, there's all sorts of potential vulnerabilities in the financial sector, but what I would say is that we went through quite a rigorous exercise after the global financial crisis to try and make sure that banks and other financial institutions were properly regulated, and we didn't go back into those types of problems. So hopefully, as Rupert has said, the regulators are on top of the problems, and we haven't got too much in terms of hidden problems in the financial sector.
Rupert, even like 2-3 weeks ago, maybe 4 weeks ago, we're still talking about the possibility of a soft landing. Is that now just gone out the window?
I think it's very unlikely. I have to agree with Jamie Dimon, that we heard at the beginning of this segment. I think that we are now heading for a recession in the US, maybe a mild recession. I think we're certainly either in or about to enter a recession in Europe. I think the issue is more a medium-term issue, which is that the CPI print yesterday was bad. It's really bad. Like, we have got very deeply ingrained, very broad-based inflation in the US. Even more medium-term concern is that wage growth, as Andrew was saying, in the US is very, very high. And I think when you look at historical episodes, you need to have a significant increase in unemployment in the US in order to bring wage growth back down to acceptable levels for the Federal Reserve. And unless we get some very, very positive downside surprises in inflation and wages, that soft landing seems very, very hard to combine with acceptable inflation outlook.
But so what could stop the dollar's rise? Do we need the world economy to get better, and how long could that take?
Well, I think the dollar's rise continues. We've been long dollar for a long time, but we have reduced the size of that because you're getting now to some levels. And I think it's also interesting to see how the dollar's been trading over the last week or two. It hasn't been reacting to the upside quite in the same way, and I think there's a little bit of more resistance. I think it's also interesting that some policymakers are starting to talk in the US about global fragilities brought about by the strong dollar. I think we've heard Lael Brainard, for example, starting to talk about that. I don't think we're anywhere near the sort of mid-80s levels where policymakers are going to convene in some kind of plaza-style agreement to try and bring down the dollar. So I still think that there is upside risk, just because there is no... I think a good guide is every time at the moment the markets try and price a pivot in US monetary policy, that's something you want to fade, because there is no evidence at the moment to support that.
Rupert, thank you so much. Rupert and Andrew there. Andrew Senton, Senior Advisor to Cambridge Econometrics and former member of the Bank of England's Monetary Policy Committee. Rupert Harrison, Portfolio Manager for Multi-Asset Strategy at BlackRock and former Chief of Staff to George Osborne. Both joining us, of course, on the UK and the US and the world economy. Coming up, how the world of high fashion is trying to catwalk its way through high inflation. We're joined by the Chairman and Chief Executive of Moncler. He's Remo Ruffini. That's coming up shortly, and this is Bloomberg.
A digital-first approach to the future of work is where the industry and all companies will be heading.
Could the future of work not be at home or in the office, but in the metaverse instead?
There's that word, metaverse.
Doing well. How are you doing?
When I think about the metaverse, I think about immersive experiences that have a sense of active presence.
Wow, look at this. This is me. The metaverse is projected to become over $1 trillion market by the end of this decade. And whether you know it or not, you'll probably be working there in the future.
We're moving into a world where we're going to be interacting with computers with our bodies.
This is definitely trippy.
I think the adoption curve is going to be slow.
It's weird.
Like a weird floaty thing right now.
But look at you. You have no legs.
It's kind of a fun world, and we're just at the very beginning of a very long journey.
Power, policy, politics, From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect.
How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg.
You will shed light on dark matter. You will make aging optional. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
Keeping up to date with news from around the world with your First Word News, I'm Alice Atkins. UK government bonds are soaring this morning on the prospect of a U-turn on Prime Minister Liz Truss's economic agenda. Chancellor Kwasi Kwarteng has cut short his US trip to head back to London to work on the fiscal plan. This as the Bank of England's emergency intervention in the bond market is set to come to an end later today. The US investigation into the use of outside messaging services like WhatsApp at major banks is now sweeping in record keepers at big investment firms. Bloomberg has learned the SEC has asked money managers for details of who oversees retention of electronic communications at their firms. The US regulator has already issued about $2 billion in fines for improper conduct, compliance, and record keeping. The US House Committee investigating last year's attack on the Capitol has voted to subpoena former President Donald Trump. Lawmakers want to question him about the 2021 riot and are demanding documents and testimony about his role. The move comes just weeks ahead of midterm elections that will determine control of Congress. Bloomberg has learned that Mizuho Financial Group has emerged as a suitor for part of Credit Suisse's securitized products group. Sources say the Japanese bank is competing against interest from Apollo Global and PIMCO and others. Credit Suisse says the platform, which employs about $20 billion in risk-weighted assets, is highly profitable. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Now, coming up, how luxury goods are weathering the storm despite inflation and recession alarms. Our interview with the chairman and CEO of Moncler, Remo Ruffini, next. This is Bloomberg.
There is an epic saying in Italy when it comes to family generations that the first generation creates, the second generation expands, and the third generation destroys. And that's almost what happened in the Gucci story.
So hate and love together.
Now I would have a much more experience about for those who says I love you and then destroy you.
the Gucci family was the strength, but also the weakness of the label.
The situation became dire with Gucci's finances. They were not able to pay salaries. They were not able to pay suppliers. Gucci is really teetering on the brink at this stage.
Multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg.
Gilts surge on expectations that the UK government is preparing for a tax cut U-turn, while Kwasi Kwarteng, the Chancellor, flies back early from his U.S. trip. U.S. core CPI comes in at the hottest level since 1982, with inflation spreading deeper into the economy, while a 75 basis point hike next month is all but solidified. And ahead of this weekend's Communist Party Congress in Beijing, we look at how President Xi is securing his plan to stay in power. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Recession? What recession? The luxury goods industry has been largely unscathed by the economic downturn and soaring inflation so far. Now, earlier this week, the French luxury goods giant LVMH beat forecasts with higher sales as wealthy shoppers continue to spend on top-end retail. And with winter coming, luxury outwear maker Moncler is ready to capitalize on that strong demand as it celebrates its 70th anniversary. Now, we're now joined by a man who has catapulted the brand from a struggling label back in 2003 to a $12 billion luxury giant. He is Remo Ruffini. He's the chairman and chief executive of Moncler. Thank you so much, Remo, for joining us. I mean, it is amazing. First of all, thank you so much for being in London, because you've come from Milan. There's so much talk about luxury, about inflation, about where the world is. How do you see luxury developing over the next 2, 3, and 5 years?
I mean, I think luxury after COVID is changed a lot. You know, I think the people, they want totally different experience. The people love to stay outside. The people love to hiking, biking, whatever. And we have to take in consideration that, you know, digital becomes super important at the moment. Omnichannel becomes super important. And, you know, first of all, I think it's very easy, you know, from possession to experience. You know, the people really want another approach in the luxury world, from meaning to dreaming, from dreaming to meaning, you know, is totally different approach. I think, you know, we have in front of us 5 difficult years, I think, you know, because the world is, they have trouble, changing a lot. But I think if you stay tuned with your customer, I think today is more community approach, is less one-to-one, the communication is really top-down, you know. I think we have to really match all the experience we have in the last three years. That was quite a good experience. I think the word is omnichannel. Omnichannel in terms of everything, you know, in terms of sales, in terms of communication. You have totally a lot of platform in front of you. It's not anymore digital or .com and
so how difficult is it to keep on top of all of this? So you're, you know, originally known as Mountaineering and outerwear company, but there are all these experiences. I mean, we were in one in London, and again, it's also maybe trying to be more streetwear. You have had so many fashion collaborations. Does that change the perspective on how you want to shape the company in 4 years?
Yes, I think it's again top-down. You have to be able to talk with a different community all around the world, you know, and the culture is totally different. Think about China, United States, Europe. The approach is totally different. That is obvious to say, but it's not obvious to make it.
So how is the approach different? So do people buy differently, for example, in China, the U.S.?
Not much, in case the communication now is top-down. You have to talk with the community, and then the community come to your stores. Means this is the difficult things, you know, since, you know, America is quite easy, not easy, but because there is a lot of micro community today, but we know better. But China, for example, that is super important market for us, is not obvious. First, we cannot travel there since March 2020, means already almost 3 years, and it's changed a lot, especially in the digital world. China improved a lot, everything, and now the game is really to stay tuned with them, understand the culture, understand the ideas, understand what they're looking for, and this is really the game for the near future. And then, if you think about for a company, this possession is important because you need to buy jacket or whatever. Right. You have to build up an experience. Build up an experience to the world is totally different than 5 years ago. I'm sure for the next 5 years, we really have to match physical and digital approach. I always say digital become very important, especially
digital to what? To make you dream, to make it appealing. Is it less physical stores to buy, or is it just all about experience when you go to a physical store?
Honestly, after COVID, physical became stronger and stronger for sure. But I always say digital, the .com, the e-com will be the future for sure. But we have really to transfer the physical experience into the digital world. That seems obvious, but it's not, because now it's very catalog approach. Every e-com of the luxury world. I think the game is to be more immersive, give the possibility to be more immersive. I don't want to talk about metaverse. I think metaverse is not
something else.
Yes, it's the next 5 years. But I think from now to metaverse, I think we have to build something, an organization, a structure, in our .com that the people feel and experience. Otherwise, I think it will be difficult to transfer the revenues from the physical world into the digital world.
So does that mean that you also want to acquire companies that maybe do experiences, or is it outside? I know you've, in terms of expansion, how much bigger will you be in 5 years?
This is very, we have in front of us a difficult moment. I think, again, we have like 6, 7 short term. We have the election, we have the Congress in China, we have many things, the war in Ukraine, we have inflation. Inflation is, is quite tricky in Europe at the moment. We have the midterm in America. We still have COVID around. It's very difficult to say, but I'm quite positive. The company is super well managed. We have really rigor in everything we do, and I think we have vision for communities. That's what I said before. And I think we have strong positivity. We just make an acquisition on
Stone Island.
Yeah, Stone Island 1.5 years ago. I feel we're very concentrated to redesign the organization. I feel they have potential to attract different communities than Moncler. I feel that Stone Island can come in this new world of luxury. That I really feel is.
How do you segment, Remo, luxury? There's the very high end, there's the kind of high luxury, and then there's like the middle ground. Is the high end actually almost, recession-proof, inflation-proof, because you can hike prices when your raw materials are more expensive?
I think the world is divided, I think, in 2 areas in the luxury world. I think the traditional luxury, we talk about Chanel, Hermes, Dior, for sure they are the strongest but since 3, 4, 5 years, this street, think about New Bond Street, Monte Napoleone, Faubourg Saint-Honoré was quite sad 5 years ago. Now a lot of young generation is there, thanks to some brand. Gucci was one of the first. We did with Genius, we attracted a lot of young kids. Balenciaga, Loewe, this kind of brand that give more energy to the customer. I think was able to attract new generation customer into the luxury world. And now you match the old and classic, let's say, not old in terms of style, but the traditional luxury brand with the new upcoming luxury brand. I think this energy, you feel it. I think is something very positive for us, very positive, I hope, for Stone Island in the near future.
What are you most excited about the future? Again, you're celebrating your 70th year anniversary for the brand, which is quite incredible through all the phases that Moncler has been going through.
Yeah, for Moncler, for us, I think the anniversary was very important to us to stop for a while and think of the future. I think what we did in the last 70 years, what they did, because I was not there, because I managed the company in the last 20, I think was really not betray the roots, stay tuned with the roots, but at the same time be modern, contemporary. And I always say, too, it was my slogan when I've been public, say, survive fashion. I think for us, survive fashion, we are in the fashion world, but we have to stay very consistent, and survive fashion is, I say,
It's a good, I try to do that every day. Talk to me a little bit about, if you look at politics, and certainly politics in Italy, you're listed on the Milan Stock Exchange. What do you need from this new government to help you grow, to support you, and to attract investors?
We're in a tricky moment, because we just have the election. We're going to have the new government in end of October. I think we need the rigor, first of all. We need execution in economy. As you know, our debt is very high. We have to control this. Reputation for the world. You know, I think in the last 400 days we have Mr. Draghi manage Italy. I think was a very good was a turning point for me. You know, we have a huge reputation all around the world. I feel when I walk in the street, when I talk with the people all around, you know, we go in New York, you know, Italy is Italy now, today.
Okay.
And now we have the Italians choose another way to manage the company. The
country, which is like a company,
exactly.
just a much
for
bigger.
For me, it's a company, you know, because they have debt, they have revenue, they have marketing and everything. Now I think that this lady, Mrs. Meloni, she's serious, but you know, to manage a company with 2.7 trillion debts is another game than make politics in general. You know, means let's see,
Okay.
let's hope.
Let's hope and see. Thank you so much, Remo Ruffini there, the chairman and chief executive of Moncler. I like that. We all just try and survive fashion. Coming up, Liz Truss reported to be preparing to abandon a central part of her UK tax cut plan. We'll bring you the very latest on the UK. That's coming up next, and this is Bloomberg.
There's more activity in the fusion world than ever, and not just in government research labs. There's also an emerging private fusion industry that's attracted billions of dollars in capital in recent years.
Governments and private investors alike realise that we've got to find a solution that's going to allow us to get to net zero targets.
This is one of the hardest but most rewarding problems that humanity could work on. Ultimately, we all want the same thing. We want someone to put electricity on the grid from a fusion power station as quickly as possible.
Frankly, the scale of the challenge, 3,000 gigawatts of fossil fuel to replace, there's not many things that can do that. In fact, there may only be fusion that can really do that.
And while many in the scientific community predict fusion power will take decades, some in the private fusion space believe we'll get there in just a few years, as soon as the 2030s.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
I've
been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
I think the Fed is doing exactly what they told us they're going to do, right? So the markets may not like what they're doing in certain cases, or they may wish that they were doing something else, but the key to successful central bank intervention is to actually do what you say you're going to do. So I think the challenge that you have in the UK, for example, is a lack of credibility and a lack of clarity. The Fed is telling us exactly what they're going to do. They're doing it, and the markets are responding.
The Ares Management President, Chief Executive and Co-founder Michael Arrighetti on where he sees buying opportunities in the credit market. Now, the pound lower gilts bid this morning amid reports that the Prime Minister, Liz Truss, is preparing to abandon a central part of her tax-cutting agenda. Now, the Chancellor cut short his trip to the U.S. just hours after insisting he's not going anywhere.
Our position hasn't changed. I will come up with the medium-term fiscal plan on the 31st of October, as I said earlier in the week. And there'll be more detail there. What I'm totally focused on is on delivering on the mini budget, making sure that we get growth back into our economy. I'm not going anywhere.
So is Bank of England Governor Andrew Bailey's gamble ending an emergency bond buying program today paying off? Well, we're joined by Lizzie Burden outside number 10. So Lizzie, the U-turn on corporation tax now seems inevitable. What can we expect from it?
Well, Kwarteng left in the early hours of the morning UK time from Washington, and if you look at the BA flights, you could deduce that he's either already on UK soil or about to arrive at about 10:45 a.m. And you would assume that he'd be straight on his way here to number 10 Downing Street to see Liz Truss for crisis talks. And you could speculate that they would make this U-turn before the market open on Monday at least, because this has already been priced in, and so they're not going to want to see a sell-off on Monday morning. Given his rushing back, perhaps it'll be even sooner than that. But in terms of where it leaves Liz Truss, more U-turns now seem inevitable. She does seem to be in office, but not in power. And there's speculation as well that the Tories would change their rules so that they can change leader to perhaps Penny Mordaunt or Rishi Sunak, who ran against her in the leadership campaign. But if whoever is the new leader would have a very diluted mandate, there'd be pressure for a general election, and at the moment, it looks like Labour would win.
So, Lizzie, where does it leave the BOE? Today's the last day, of course, of its bond buying operations.
Yeah, well, in the game of chicken between the Chancellor and the Governor, Andrew Bailey seems to have won because it's Kwarteng who seems to be about to do the U-turn. Of course, Andrew Bailey said that the pension funds had 3 days to get their act together. Implicitly, that seems to have been a message to the government as well. Our reporter Phil Aldrich was in Washington, and when Andrew Bailey was asked whether this U-turn would be the answer to the market turmoil, Phil says Bailey's response was a big grin. And so where it leaves the Bank of England next, if the market turmoil does continue but they end the programme today, perhaps there's room for a more creative solution. I was speaking to former BOE policymaker Martin Wheel yesterday. He suggested that there could be targeted help for the pension funds that are in trouble. But really, Andrew Bailey is going to want to get away from the blunt instrument of quantitative easing so that he can focus on inflation fighting, prioritise that over financial stability, and stop getting dragged down the path of fiscal dominance. That's what the message was from the IMF yesterday.
Lizzie, thank you so much. Lizzie Burden there with the very latest on this bond buying. Now let's bring in Bloomberg Opinion's Marcus Ashworth. Marcus, thank you for joining us. Is this just the Bank of England governor being lucky, or was it a genius move?
I think what's really going on is the pension regulator behind the scenes is wielding a very large, probably very unpainful stick to a lot of the pension trustees. And we see the price action yesterday, not so much in the conventionals, which show the Bank of England was being very generous in their pricing, but particularly on the index-linked part, the linkers, people were selling at levels way, way below where the market is, because they've been basically told to, in large size, get out of these situations now. And today, I'm sure we'll see the same. They may even increase the amount they buy. I think the Bank of England will be very flexible on these things, and I think they may buy a very large amount today. It's possible, because I think the message has come loud and clear from that pension regulator. You have no excuses come Monday if you haven't sorted yourself out with regards to collateral and needing what you need to sell into the Bank of England.
So Marcus, how would you explain it? I mean, it's very difficult to look at, the numbers and say how much of this, support actually came from BOE bond buying and how much of it is actually gilt buyers wanting to come back in because of the U-turn and the fact that they feel more at ease with the government plans.
Yeah, well, it's difficult to always separate the politics away from. I thought it was more Bank of England, but then, with the politics going on, it's possible that quite a bit of it is. But there's also been a lot of speculators in here making a lot of money. Good for them. It's a free market. They're getting squeezed here as well. What a shame. So we will have some shorts, hopefully feeling a bit of flame underneath them. And clearly, I think that we have to wait till Monday till we know that any of this works. The big gamble from Bailey. I suspect, as Lizzie was saying, this isn't QE. They don't want to call it QE, but all intents and purposes, people feel like it's QE. But they may do other things next week. And we also have the various repo measures in place, which should offer a little bit more stability, certainly on the sort of plumbing of the system, which has obviously gone very awry the last few weeks.
Yeah, so actually, can you talk to me a little bit about that? So what's this repo facility exactly? I mean, can it be a real backstop, or because it has to be the banks for the pension funds, it doesn't have as much teeth as, of course, as Bank of England just swooping up gilt?
Well, as we've seen with some of the stories coming out about Northern Trust having a sort of a logjam where they didn't have enough staff to process manually, the raft of sales, a lot of collateral requirements, particularly into clearinghouses like the LCH, are required instantly that day. So if you sell something, you may only get it 2 or 3 days later. That created a real pressure, which we saw the Bank of England respond to by offering to buy gilts back. So in that context, clearly there needed to be something sorted out to prevent that plumbing blocking up. And they've done a raft of different things. Some of them are temporary, but practically speaking, every week from now on, permanently, you can turn up at the Bank of England and deposit whatever asset you have, as long as it's sterling investment grade, corporate bond, gilts, linkers, a raft of other different stuff, and they will give you cash. So that should create a much calmer system whereby people can know they can get access to top quality collateral and sense cash when required, selling assets as long as they are of a certain quality, which the Bank of England's made very clear. And it's not just restricted to primary dealers or the gems. It's a wider thing rather than just banks and regular players.
So, Marcus, one of the things that you're very good at is also seeing stresses in the markets. I know you've been covering financial markets for quite some time. We spoke to Sir Howard Davis of NatWest just 2 days ago, and he was saying that he'd be casting his eye on some of the areas of the shadow banking, or really anything that could hurt significantly as interest rates are going up quite a lot, because the LDIs really came as a surprise. Is there any area in the market right now that you are worried about?
Well, clearly, we've seen a massive stress test of leverage in the system, which people perhaps turned a blind eye to, though it was obviously hiding in plain sight. I mean, when you get super low bond yields for a very long time and you force pension funds into buying them and insurance companies, and then all of a sudden yields just jump exponentially, of course there's going to be fallout. And clearly the shadow banking, or indeed the hedge fund industry, on a raft of other different measures are exacerbated because of the way we switch to these centralized clearing houses, which is great news for counterparty risk. It solved the Lehman Brothers problem, the global financial crisis issue. Unfortunately, what you got now is a sudden requirement for only the best quality collateral intersecting those derivative trades, every day, day on day, the variation margin. That's caused a massive squeeze as far as getting hold of cash when you need it and top quality collateral. That's why we caused this problem. This is a wider issue, not just the UK markets, but global markets. I don't think there's a radical solution needed. It just needs a bit of better regulation. The regulator has been asleep at the wheel. I mean, Bailey himself was in charge of the Financial Conduct Authority for a lot of the last few years. So a lot of questions need to be asked on how markets are regulated, not just in the UK, but let's start in the UK, because clearly we need to get our act together.
Marcus, thanks so much. Marcus Ashworth, our Bloomberg opinion columnist. Now, coming up, Chinese authorities moved to censor social media after an extremely rare protest criticizing President Xi Jinping just days before the Communist Party Congress. We have plenty more on that story next, and this is Bloomberg.
What do you think of when you think of a battery? For most, it's what we use to power devices for both work and play, and maybe even your car. Over the past few decades, they've gotten way more powerful, long-lasting, and affordable. But all of this is just a prologue to what the next batteries are going to do.
As we drive to an increasingly renewable power-driven grid, we also need to be able to store energy and release it later to cover those periods of weather intermittencies that are driving this new grid that we're in. It's a multi-trillion-dollar opportunity, and it's imperative that we figure out the solution here.
How we store energy on a massive scale is in many ways the central challenge of the fight to stop climate change.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacroix here in London. Now, China's Communist Party Congress begins this weekend with a host of challenges facing the nation's leadership. Now, to dive deeper into all of this, let's bring in Bloomberg's Rebecca Chung-Wilkins. Rebecca, thank you for joining us. So what kind of language should we be watching out for in the speeches?
Well, there's two really key terms, I think, that investors and traders in particular will be watching. The first is how Xi Jinping balances the need to manage risk and security with development. This slogan has sort of become more prominent over the last couple of years and really speaks to, of course, those crackdowns that we saw on tech, property, this idea of common prosperity. The other thing to look at is what sort of successes that Xi Jinping touts as good indicators of China's move to emphasizing the quality of growth rather than quantity of growth. And that will give some kind of indication of the direction of travel.
So, Rebecca, is there any hope for a lift to markets after Congress like we've seen in the past?
Well, absolutely. I think typically we do expect to see a little bit of a boost, usually coming into Congress, actually. And there was some optimism that there could be lifting of policies around COVID zero, for example. But unfortunately, I think there is, a much deeper pessimism has set in. It's very unusual to see markets, everything from equities to currency to credit markets, performing so badly like this ahead of a key party event. Normally, there's a big emphasis on stability and shoring things up. But it is really sort of a reflection of sentiment because of the slowing economic growth and the continued drag, on the one hand, of this property crackdown, but also of ongoing COVID lockdowns. And really, when we look at some of the recent state media commentary, it does look like we're going to see a doubling down on the efficacy of COVID zeros, at least for the next few months.
All right, Rebecca, thanks so much, Rebecca Chung-Wilkins. So we, of course, have a lot going on. On Sunday, it's the People's Congress in China. Today, it's all about Andrew Bailey, guilt, and what we hear or not from the government on that U-turn. Bloomberg Surveillance Early Edition continues in the next hour. Kaylee Lyons in New York, Anna Edwards here in London, and this is Bloomberg.
Apple's delaying its next major iPad software update, iPadOS 16, by about a month from September to October. Apple made the decision for a number of reasons, including a still buggy Stage Manager multitasking interface, and in order to link the launch closer to the more similar macOS Ventura. Still, it's an unusual move. Since shifting the launches to the fall in 2011, Apple has released its new iPhone and iPad software updates simultaneously each year around September. By staggering the releases, users may find some issues around compatibility with cross-device features like retracting and editing messages in iMessage, the new shared iCloud photo library, and the new feature for transferring FaceTime calls between iPhones and iPads. It will also make it a bit harder for developers to launch apps that run on both the iPad and iPhone that require new APIs and features found across iPadOS 16 and iOS 16. Regardless, it was still, of course, the right move. Stage Manager on iPadOS 16 is still quite buggy, I don't find it particularly intuitive, and it's not compatible with most iPads and many third-party apps on the App Store. The feature clearly needs some more polish. And complaints from consumers about Stage Manager will now no longer probably overshadow the earlier launch of the iPhone 14.
When U.S. inflation numbers are released,
the score is inflation one fed nothing today.
Bloomberg brings you crucial data at terminal speed.
Core CPI in America, 40-year high.
Yields are absolutely flying.
Equities down and down hard.
It's ugly.
And instant expert analysis.
What is the makeup of this inflation?
We are watching the underlying fundamentals.
Will they go 100 basis points?
The downshift just keeps getting pushed out. Now it looks like we're going into extra innings.
Nobody covers the economy like Bloomberg, your global business authority.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia.
This is Bloomberg Technology. Welcome to Bloomberg Crypto.
There's a lot of uncertainty here.
There's much less certainty around the dynamics at the moment.
I think everything is a tightrope.
Frankly, everything's on sale. I mean, we're down 25% on equities from a year ago.
People are really hesitant. That means they think the market isn't oversold yet, and that we're not going to hit the bottom yet.
This is Bloomberg Surveillance, early edition with Anna Edwards, Matt Miller, and Kaylee Lines.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. Record reversal. The S&P 500 defies expectations, roaring back from losses sparked by that hot U.S. inflation reading. Asia and Europe join the rally, but U.S. futures now fade. UK tax U-turn. Prime Minister Liz Truss prepares to abandon key measures of her economic plan following weeks of market turmoil. Chancellor Kwasi Kwarteng races back from Washington. And JP Morgan, Citi, Wells Fargo and Morgan Stanley kick off bank earnings season today with the Fed hikes in focus. Jamie Dimon warns it's unlikely the central bank can pull off a soft landing. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Kaylee Lines in New York. Matt Miller is off today. And Kaylee, whatever it was that caused that intraday reversal in US stocks yesterday, it certainly successfully spread around the world through the Asia session and then into Europe.
Yeah, whatever it was, Anna. I was watching the charts yesterday wondering what was possibly going on after that hot CPI print. Thankfully, we're going to have Danny Berger break things down for us in just a moment. First, though, I do want to check on Asia, which, as you mentioned, really followed through on the rally we saw here in the U.S. The MSCI Asia Pacific Index as a whole up 1.8% overnight. Certain pockets of outperformance as well, including from China, where the CSI 300 rose about 2.4%. Of course, we're anticipating the Party Congress beginning this weekend, but also maybe lifting risk sentiment there is the fact that inflation data out overnight came in a little softer than expectations. You also had Japan outperforming, the Nikkei 225 up 3.25%, actually the best day for those stocks since March. But one Japanese asset not having the best day is the Japanese yen, weaker against the dollar today to 147.65. Of course, yesterday hit the weakest level going all the way back to 1990. So we are watching potentially for fresh intervention in the Japanese yen. Then when we take a look at the U.S. picture, it's a different one this morning than we saw yesterday. Of course, we saw a 5% swing in the S&P 500 from the lows to the highs of the day where we ultimately ended. Today, though, after earlier gaining in the futures session, we're rolling over. S&P E-minis now down about 0.4% as we see some buying coming back into the bond market. We're down about 3 basis points on the 10-year Treasury yield. 391 is where we trade, while at the short end, the 2-year is at 442. Finally, it is a day of dollar strength. Anna, Bloomberg Dollar Index trading at 1343 at the moment.
Yeah, and you wonder if there's a link between that dollar strength and the stock risk asset weakness that we're seeing now, certainly expressing U.S. futures, Kaylee. This is an expression of yesterday's story on Wall Street, really. We're catching up with Wall Street. We've got European stocks moving higher today, up 0.7% in London, up around the same in Paris, and a bit less than that in Germany. It's pretty broad-based. It's been throughout most of the sectors throughout the last 2 hours of trading here in Europe, just as Wall Street was pretty broad-based. There's a lot of focus, once again, though, on UK assets. Let's get to some of that. We've got the 30-year yield in here coming down once again. So we're seeing a lot more appetite for UK gilts this morning. We look ahead to the tender offer, the last of its kind from the Bank of England a little bit later on. So we'll see the size and scale of the Bank of England's intervention. How much are they buying at this point? But we've got the 30-year yield down at 4.36%. The pound at 112.70. So the big move in the pound seemed to happen yesterday, an expectation of a U-turn then coming through from the UK government. So we saw big moves in the pound higher yesterday, and we just come off those today. So 112.70 down by around 0.5%. Feels like there's some big experiment going on here in the UK about what happens when you pull certain fiscal levers, and we hope the rest of the world is taking note. This is what's happening in Hungary at this point. We've seen big moves in the Hungarian currency. This after an announcement by the central bank, an emergency rate hike by the central bank. They've introduced a new one-day deposit rate that's going to be at 18%, more than the 13% base rate. And with that, they set off the biggest rally in their currency since 2011. And it is the weakness in their currency they were trying to get ahead of, as instructed by the Prime Minister. He wants inflation down from above 20%. And gas futures, I bring you a slightly better story here, Kaylee. This is nice. 91% storage full in Europe, 95% storage full in Germany. That doesn't tell us how full it'll be in February, March, of course, which is important. But also some of the 7-day forecasts for weather, some of the longer-term forecasts for weather are suggesting that temperatures will be above average through this winter. And so when you're looking for good news, that is it. And as a result, the gas price is down by 4.4%.
All right, Anna, bringing the good news on a Friday morning. What's so interesting to me is that yesterday when we got inflation data, you could have considered that bad news. And yet we got a shock turnaround in equities that sent Wall Street searching for something to explain how another red-hot inflation number translated into the best day for bulls in a week. Bloomberg's Danny Berger joins us now with a closer look at yesterday's action. Danny, please explain.
Look, Kaylee, I'm going to do my best, but let me just, huge disclaimer on this whole thing. These are really just guesses at the end of the day because we don't know. I really like how Liz Ann Saunders put it. I mean, this is the nature of the beast these days. Things can turn around on a dime. All right, let's kind of dig through some of these clues to try to figure out why it turned around and what that means. So yes, we get CPI coming out yesterday, and the market, I mean, it just absolutely tanks. Now, it's super easy to blame the algos. Maybe there were some mean reversions levels triggered that started this buying, and then trend following just follows on. But again, that's one of those things that's hard to actually ascertain whether it happens. Now, one of the clues is when the market was diving, the VIX was moving lower at this point too, which is strange. You'd suggest more market volatility, VIX should move higher. But it does suggest that some hedges were being unwound. So perhaps that's one of the clues of why it eventually turned. Now, a lot of folks have said this was a short covering rally. That's not exactly right. It at least wasn't a plain vanilla short covering rally. And one of the ways we can tell that is by looking at the Goldman Sachs index of most shorted stocks versus the S&P 500. The most shorted stocks underperformed. It only gained 1.4%. Overall index gains 2.6%. Usually the most shorted stocks just absolutely rip on a day of short covering. So clearly this was not individual stock led. Now, it still could have been short covering, but it would have been moved by something more technical. I know all of this is a bit technical, but we had a lot of folks buying puts before yesterday. We had some days of record put buying as well. So if the market tanks, puts become profitable, folks trade those in, the dealers on the other side, they're short the market to have a neutral position, and then they need to short covering. So if it's short covering, it was a weird technical one. Now, all this mumbo jumbo is to say that it does look like it was because of market mechanics. So Anna, at the end of the day, that fundamental bearish story Still not gone.
Okay, Danny, thank you so much. That is why she's here, to explain the tough stuff. Danny Berger with us on what was driving markets. I spoke to a guest at Credit Suisse who was saying, yes, she was not convinced that we had turned any kind of material corner with the enthusiasm for risk assets yesterday. Let us get to, talking of turning corners, let us get to UK politics. What could we expect from the Prime Minister, Liz Truss, today? Some kind of U-turn, perhaps. That is what's being reported. And is she preparing to abandon a central part of her tax-cutting agenda after weeks of chaos in the markets? The Chancellor has cut short his trip to the United States and is heading back to London just hours after insisting he's, quote, not going anywhere.
Our position hasn't changed. I will come up with the medium-term fiscal plan on the 31st of October, as I said earlier in the week, and there'll be more detail there. What I'm totally focused on is on delivering on the mini-budget, making sure that we get growth back into our economy. I'm not going anywhere.
Well, he certainly thinks he's not going anywhere in terms of his job. He was going somewhere, though, Lizzie, in terms of his travel plans, because he left Washington early, on his way back to the UK as we speak. Lizzie Burden, our colleague, joins us from Downing Street to take us through the latest. The U-turn on corporate tax, corporation tax then, not announced, but certainly being talked about by a lot of people. Is that what we expect?
Yes, Anna, it's a question of timing now, it seems. If you look at the British Airways flight schedule, it would appear that we can expect Kwasi Kwarteng to land on UK soil around 10:40 today. Then you would expect him to come to Downing Street for crisis talks with Liz Truss about when to time it. Now, you would expect that they would announce it before the market open on Monday because, of course, this U-turn is now priced in, and so they're not going to want to see a sell-off at the market open when the Bank of England's emergency bond buying program would already have been withdrawn. But then the question is, would they actually want a weekend of speculation? Is Truss wanting to speak to her friend Kwasi Kwarteng today, and will they announce the decision later today? But really, it's leaving Liz Truss very much a lame duck. As you say, this is another key plank of her economic policy. The idea was to boost growth. So the Times is reporting that the Tories are plotting to change their rules, replace her with Rishi Sunak and Penny Mordaunt, who of course ran against her to be the leader. But whoever would take over from Truss would have a severely diluted mandate, and judging by the polls, you would expect if there had to be a general election, Labour would win.
Okay, Lizzie, you mentioned the bond buying program of the Bank of England ending. Today is the last day of that. Where does this leave Andrew Bailey and his team?
Well, it seems in the game of chicken that he was playing with the Chancellor Kwasi Kwarteng, Andrew Bailey has won, and it's the Chancellor who's going to have to U-turn. Remember, Andrew Bailey had said that the pension funds had 3 days to sort themselves out. Implicitly in there, it seemed it was a message to the government to sort itself out. But if the market turmoil continues after today, perhaps we can expect a more creative solution from the Bank of England. I was speaking to former BOE policymaker Martin Wheel yesterday. He suggested they could provide more targeted support for pension funds. But what the Bank of England is going to want to do is get away from the blunt instrument of quantitative easing so that it can reprioritise inflation fighting over financial stability and stop getting dragged down the path of being dominated by fiscal policy.
All right, Bloomberg's Lizzie Burden reporting from Downing Street. Thank you so much. Let's get to corporate earnings now. U.S. banks are set to kick off what will be a very closely watched third quarter earnings season. J.P. Morgan first up this morning, and Citi, Wells Fargo, and Morgan Stanley are all also on deck to report today. Their outlooks will be heavily scrutinized for clues about the state of the industry amid growing recession risk. J.P. Morgan CEO Jamie Dimon spoke yesterday, offering hints of what his bank is bracing for.
I don't know if it's going to be a soft landing. I don't think so, but it might. Mild recession or tough recession. My point, in the tough recession, yeah, you would expect the market another 20 or 30%. I'm not going to give odds across those three things, but for all of us who have to worry about risk, yeah, of course you should plan for those things.
Shonali Basak, our global finance correspondent, is joining us now with more. So Shonali, it's not the prettiest picture for these banks. They're facing a lot of headwinds. What are you going to be watching for in these reports?
And that's the thing. If Jamie Dimon expects that there won't necessarily be a soft landing and a mild or a tough one, then what does that mean for provisioning for loan losses? The expectation right now is about $1.2 billion over at JP Morgan, about half of that at Wells Fargo. It's interesting to see what will happen, not just on the consumer side, but the investment banking side. It's a rare day that we have 4 big banks reporting at the same time. So a lot of things to watch between the differences between the type of clients that JP Morgan and Citigroup and Wells Fargo have and the Morgan Stanley Wealth Management clients that may or may not be feeling the same type of pain in the market that some of the other consumers are.
Okay, yeah, Shonali, 4 at the same time. That really isn't fair. How does this set us up for the rest of the year then? What do we look out for longer term?
I think what's interesting also is you're starting to see a lot more pressure on those trading desks because even places like rates, commodities, fixed income, some banks are doing very well, Anna, but then if you look at that larger FIC business, you've seen some firms already be burned by mortgages and mortgage trading, for example. So is there more pressure in those businesses that started to create a ballast to some of those other areas that started to see some weakness? Also, are we going to see more of the yield curve inversion play a bigger role here, kind of offsetting the optimism behind that net interest income gain? All of this is to say this is the end of the year. Bankers will be telegraphing what their staff will be really looking like into next year, whether they'll need to do a little bit more by way of headcount reductions, and what they will have to do in terms of efficiency and managing compensation in order to meet lower profitability.
Shonali, thanks so much. Bloomberg's Shonali Basak there with a preview of what to expect from the bank earnings season. And we'll have more on US banks and what we expect to hear from them later this hour with Bloomberg intelligence analyst Alison Williams. Coming up on this program, we'll dig deeper into the UK story. Gordon Shannon joins us from 24 Asset Management, where he's a portfolio manager, the plane carrying the Chancellor of the Exchequer on his dash back to London, currently somewhere over South Wales on its way to Heathrow. We'll also talk to Jeffrey Yu, BNY Mellon's senior market strategist, about UK assets, sure, but also about US assets post that CPI print. And it is the 20th Chinese Communist Party National Congress kicking off this weekend. Stick with Bloomberg for special coverage starting on Saturday night and all through the week. This is Bloomberg.
Very transparent to the shopper before they accept an order, what the order is going to look like, how much we're going to pay them, and how much like the consumer is paying them, and so they can decide whether they take an order or whether they refuse it. And that's the kind of flexibility that our shoppers really value and the kind of transparency that they want.
Are you seeing a labor shortage right now, and what are you doing to combat that?
It's different in different places. Our demographic of shoppers is completely different from food delivery and ride sharing. We're 70% women and half of them are moms. And that's because a lot of the job at Instacart is very different than just being in a car with strangers. It's about like going to the store, doing a good job of customer service, of really picking the right products for the consumer. And we are seeing that being very appealing to women.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
season is coming.
Markets bracing for another big earnings season.
Everyone is expecting it to be poor.
Had big markdowns on earnings.
Bloomberg breaks the numbers first.
The bar has already been set pretty low.
The big question is, can it go lower? We're seeing some pretty bad earnings already from those who have reported.
With exclusive expert analysis.
Which aspects of the market are not sufficiently priced?
Is this a macro huge headwind?
There is some really bright light at the end of this tunnel.
When is this floor going to come? When can I start buying?
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Kayleigh Lines in New York. Matt Miller is off today. And let's return to the theme, one of the themes of the week, and that is around gilt markets. For our radio audience, I'll describe the chart we're going to show you. A chart essentially of UK gilts and what yields have been doing. This is the 30-year yield, which is extremely topical. That's where the Bank of England has been intervening. That's where the Bank of England has been buying at the long end of the curve. Just before we got that fiscal plan announced, of course, we saw those yields go higher. They were tracking substantially higher. The Bank of England stepped in, those yields came down. They started then going up again. And now as we hear reports of a U-turn by the government on those unfunded tax cuts, yields come down. Let's get some market analysis. Gordon Shannon, portfolio manager at 24 Asset Management, is here with me in studio in London. Gordon, very good to speak to you. So we're all waiting to hear what the government has to say later today, over the weekend. If we get some U-turn, how big a U-turn do we have to see to calm gilt markets? Is it possible to say? Because there's talk about U-turning on corporate tax, but that's only £18 billion. The IFS says the hole in the fiscal plan is 60 billion. So does the size matter, or is it the signal we're looking for?
I think it's the size, because the signal is important that the government is finally listening, and it appears we've been caught in this game of high stakes poker between the chairman of the Bank of England, Andrew Bailey, and I'll stress, the current Prime Minister, Liz Truss. But what's been forgotten is the other player in this game, the bond market, and the bond market is certainly unhappy with a large unfunded fiscal expansion. Ultimately, gilt investors won't write blank checks. So yes, I think a reversal in that, in the plan to freeze corporation tax alone, I think we'll have to add in the national insurance as well.
Okay.
But that's tough, because that one's going to come in next month.
Okay, so that's a couple of areas where we're looking for some kind of U-turn, or at least that we're thinking that that's where it might fall. What about the preparedness of pension funds and the gilt market for going back to life as normal on Monday? Because if the Bank of England is going to stop its bond buying programme, as it says it will, do we know whether pension funds have taken this time to rebuild collateral, if LDIs, these liquidity-driven investments, are going to be in a fit state to meet margin calls? How is that going to play out on Monday?
From what I've heard, I think that's been handled quite well. The Bank of England did gain a lot of the market's confidence in its intervention. And, you know, looking at that chart that we mentioned before, it's guided the market down, allowing it to step down each day in an amount where the LDI schemes were able to raise the appropriate collateral to handle those moves and take us back to roughly fundamentals. I think that the LDI schemes, from what I'm hearing now, have taken their leverage from around 3 times at the end of September to 1.5 to 2 times now. They would have come into the year with around 150 to 200 basis points worth of gilt moves, collateral for those kind of moves. That was all used up by June, so they were in a precarious position. And then, of course, the mini budget absolutely blew them out of the water. At this point, I think they've rebuilt themselves to having around 300 basis points worth, but they're still trying to get to 400. So, and to do that, they're continuing to sell risk assets. So that's a negative overhang that will be on top of the market.
That's some great detail. Gordon, Kayleigh, jump in.
Well, Gordon, you're talking about the rebuilding of some of these pension funds. What about the rebuilding of the Bank of England's credibility? How much do they have left?
Well, that's, you know, it's been described that Andrew Bailey's gamble, his bluff here, has paid off well. I mean, I think that was reckless. I think on Wednesday, when he made these bombastic comments about the fact that the buying would end this Friday, that was unnecessary. He could have privately cajoled the LDI schemes to get on with their selling, but he should have allowed a bit more ambiguity in the market. We could be in a different scenario right now, where the Bank of England would be forced to continue buying on Monday, and then its credibility would have been pushed even lower. Ultimately, controlling inflation is what the Bank of England really needs to get on with.
Right.
And that's why, aside from the very short term, I would be fading this move.
Well, on the controlling inflation, they are going to need higher interest rates to do that. Gordon, it's not even just a question of what the Bank of England ultimately decides to do today with the ending of this program. It's what they do in November. What should they do, and what do you think they ultimately will do?
So I think they should be hiking by at least 100 basis points, and crucially, not having that alongside dovish messaging. I think they should be indicating that there'll be another 100 at the next meeting, and that those hikes won't be getting reversed anytime soon. In reality, I think it's more likely now, especially if we have this U-turn, and that's looking more and more likely, that we perhaps only get a 75 basis point hike and some dovish noises that perhaps the next one will only be 50 basis points. I think that's nowhere near enough, given how sticky UK inflation appears to be.
Okay, and is it rate hikes that are going to bring down inflation, Gordon, or is there room for government to make policy changes here? And away from the politics of it, which would be controversial, the labour market is really tight. Yeah. If they changed immigration rules in some way, that might provide some, that might alleviate the pressure on the labour market, but obviously that has politics attached. What kind of policy choices does the government have?
I mean, I think first of all, the government could try hard to not make things worse. So that would be my first request. But yeah, the labour market continues to be tight, and it's tight for the kind of the worst possible reason. Consumers are continuing to be squeezed, but unemployment is falling, but that's because the inactivity rate, the participation rate is not rising. So there's a lot of people off on long-term health problems. I think that's a hangover from COVID-19. Brexit and the immigration controls have not helped, but this is a global phenomenon, and there will be a very lagged impact of any reversal in those. So I don't see any quick way to turn around the tightness in the labour market.
And when we're talking about turning things around, there's also an energy shortage and a cost of living crisis that the government is trying to deal with. Gordon, what is the optimal policy prescription for that?
I mean, ultimately, what really worries me is that governments are running naked shorts on gas prices right now, both in the UK and throughout Europe. And in the same way that we all pretended to be expert epidemiologists during 2020, I think now everyone will claim that they're an expert in meteorology. And in the next couple of weeks, we should get fairly useful long-term forecasts for what the winter will be like in Europe. And if it's a hard winter, all bets are off.
Yeah, Anna was giving us somewhat of a positive meteorological forecast earlier.
I think he's talking about me. He was talking about me there, Kaylee. Yeah, that was my amateur meteorology, but it was based on some reliable sources. It was on the Bloomberg terminal.
Ah, yes, and that we know we can trust. Gordon Shannon, 24 Asset Management Portfolio Manager, thank you so much for joining us. Now let's get to some other stories and keep you up to date with news from elsewhere around the world with the first word. Twitter's lawyers tried again to learn what Elon Musk had told federal authorities who were investigating his attempt to take the social media company private. According to a letter unsealed in court, attorneys for Twitter sought documents last week related to the Musk investigation. By that point, Musk reversed himself on walking away from the $44 billion takeover, but he and Twitter were still adversaries in court. The Securities and Exchange Commission is deepening its probe into the use of outside messaging services and is now looking into the practice at investment firms as well as at major banks. The SEC has issued about $2 billion in fines to banking giants over the past year for the use of messaging apps such as WhatsApp due to risks around improper conduct, compliance, and record keeping. It's understood dozens of investment firms have now received requests for information from the SEC. The House January 6th committee has voted to subpoena former President Trump. Lawmakers want to question him about the 2021 attack on the Capitol and are demanding documents and testimony about his role. The subpoena is an escalation of the committee's demands to hold Trump accountable for his actions during the assault. And the manager of a $184 billion public pension fund for Texas public education employees is cutting its Chinese stock allocation in half. The move potentially cuts billions of dollars. According to meeting documents, Teacher Retirement System of Texas is switching to a new tailored emerging market stock benchmark to reduce China's, quote, outsized weight in the MSCI Emerging Markets Index it once relied upon. And Anna, of course, China is very much in focus for us this weekend and into next week as the Party Congress is being held. It's a question of the priorities of Xi Jinping and the Communist Party and ultimately what the fate of the COVID-0 policy is going to be.
Yeah, for markets, for investors, that's really important. Obviously, the geopolitics between China and the US also really influential on money managers and their willingness and ability to allocate into China. So certainly we'll keep all of those themes very much in focus. We'll get analysis of what to expect from that Congress a little bit later on this hour. In the meantime, we'll also talk to Jeffrey Yu, someone who might be able to weigh in on strategy towards China. BNY Mellon senior market strategist. So much to talk to Jeffrey about today. Could be a fascinating conversation. Stay with us. This is Bloomberg.
Apple has identified its next big business, bringing advertisements to more parts of your iPhone. Today, Apple pushes ads in 3 places: the App Store, Apple News, and the Stocks app. In the News and Stocks apps, Apple shows display advertisements. That means that third-party companies like car dealerships or mortgage lenders can showcase their advertisements just like they can on a website. On the App Store, the situation is different. There, Apple has search ads. This allows developers to buy their way into showing up higher on search results. For instance, an App Store developer can bid for the term car racing or basketball so their apps would surface above competing apps in the list of results. Apple's push into ads is a little ironic, given that its ATT, or App Tracking Transparency Privacy feature, limits the ability for Meta, Snap, and even smaller developers to generate as much revenue as possible from advertising. That's because the feature allows users to choose if they want their data collected and tracked across third-party apps and websites. Still, Apple's hoping to expand its own ads business and is planning to add search ads to its Maps app. Other areas where ads could eventually appear are on Apple Books and Apple Podcasts, along, maybe one day, with an ad-supported tier of Apple TV Plus to compete with new offerings from Netflix and other streaming video providers. I'm Mark Gurman. This is Power On.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Record reversal. The S&P 500 defies expectations, roaring back from losses sparked by that hot U.S. inflation reading. Asia and Europe joined the rally, but U.S. futures now fade. UK tax U-turn. Prime Minister Liz Truss prepares to abandon key measures of her economic plan following weeks of market turmoil. Chancellor Kwasi Kwarteng races back from Washington. And JP Morgan, Citi, Wells Fargo and Morgan Stanley all kick off bank earnings season today. With the Fed hikes in focus, Jamie Dimon warns it's unlikely the central bank can pull off a soft landing. I'm Anna Edwards in London with Kayleigh Lyons in New York. Matt Miller is off today. And Kayleigh, my sympathies go to bank analysts today trying to deal with 4 banks reporting, Chanali says, all at the same time, which sounds like a bit of a handful. In the midst of all of that, we're still seeing strength in risk assets here in Europe, but that fades into the US session.
Yeah, it definitely has faded as the future session grows older. We're still trying to contend with the CPI data we got yesterday, and now we're going to have to contend with earnings season as well. A lot of big banks reporting today, Anna, as you alluded to. So the question really is going to be, on the strength of those earnings and whether or not it can provide any kind of support to an equity market that is trying to find its footing. Yesterday, as Anna alluded to, we saw a massive turnaround from a 2.4% loss to a 2.6% gain just on an intraday basis. Absolutely wild, but we're seeing a lot of the moves ultimately of yesterday reversing this morning. S&P 500 futures down about 0.4%, an even bigger decline for NASDAQ 100 futures, which are down about 0.7%, right around session lows at the moment. While some buying is coming back in to the Treasury market, it was still a yields up day yesterday. Today, though, they are down about 2.5 basis points on the 10-year yield to just south of 392. And it is a day of dollar strength. And the Bloomberg Dollar Index stronger by about 0.4%. 1345 is where we trade at the moment. And of course, in foreign exchange, a lot is going to be paid attention to the British pound today in particular.
Yeah, absolutely, and it loses ground. In contrast to yesterday, Kaylee, let's check where we are on European assets then. The Stoxx 600 is up by 0.7%, echoing Wall Street of yesterday. If it was some of those market structures that were driving Wall Street higher, then we're happy to make the most of that here in Europe, it seems, and we go a little bit higher across sectors, most sectors in positive territory in the earlier part of the trading session today. Here's a couple of UK assets very much in focus. We're seeing buying of gilt today as we get to the end of the Bank of England's buying programme. Today is the last day. This is the 30-year yield we have here, and you can see that the yield is dropping, and we are seeing buying then coming back into the markets. The pound, of course, a strong rally yesterday on expectation of a U-turn in government policy. Remember, the unfunded tax cuts were very much the thing that led to market turmoil in gilt markets and also in the currency, and so we saw a big rally in the pound yesterday on that theme. Maybe the market looking for confirmation of that to maintain those moves today, and we see the pound actually tracking back 0.7%, 112 the handle now. Here's another currency very much on the move. This is the dollar losing ground against a resurgent Hungarian forint, and this is because the central bank over in Hungary decided on an emergency policy intervention. They have hiked interest rates, they are tightening policy, introducing a one-day deposit rate, and they're going to offer 18% on that, Kaylee, in contrast to the 13% base rate. The Prime Minister, Viktor Orban, saying he was not happy with inflation above 20%, the central bank trying to weaken the currency to have some effect on that.
All right, so another one hiking substantially, Anna. Let's talk more about central banks that have to continue on the tightening path. Jeffrey Yu, BNY Mellon's senior market strategist, joins us now. Jeff, we'll get to the UK in just a second, but if we could just begin in the US and the hot inflation print we saw yesterday, the mysterious market rally we got off the back of it, and ultimately, if it changes anything, did it alter at all your expectations for the Federal Reserve, how far they will go, how long they will stay there?
I don't think anything has changed at all. What happened yesterday, ultimately, after CPI, was we managed to figure out, in hindsight, of course, how long dollars or how long Fed hawkishness, so to speak, the market was. Yes, it was a hot CPI number, so to speak, but not extremely hot to the extent that those positions could continue or even be added to. And I think that's why risk rallied as well. Yes, we can talk about the impact of sterling and the like, but most importantly, the market has been burnt so much by these Fed pivot trades. They were all taken off, totally flipped, and maybe they flipped a bit too much.
Okay, fair enough. So you think there may actually have been something substantial behind the rebound, Jeff? If we could focus on the dollar as well, not just the equity market, because you also saw a reversal to dollar weakness. Citi publishing a note this morning saying that it's actually going to be a dollar strength story until we actually get a turnaround in the global economy and growth starts to pick back up. How much further does that dollar rally run in that scenario?
Broadly speaking, the dollar will rally, but I think it's time to start to think about differentiation. So if we look at LATAM, for example, there are quite a few candidates for relatively decent real rates. Like in Brazil, in particular, that's almost nailed on. Chile, Colombia, these are places we're looking for too. So probably LATAM currencies might start to attract more inflows up ahead, and they're benefiting from a robust US as well. China, of course, let's see what happens this weekend. Asia is an area where markets haven't really looked at all year, but with more central bank intervention potentially, and the like, and that's where the dollar will strengthen, to be clear, but maybe not do as much. Versus G10, however, versus euro or sterling, absolutely, you think the dollar, for the time being, will maintain resilience as policy sorts itself out within the ECB and BOE and the rest.
Jeffrey, let's pivot to the UK then, and many on Downing Street will be trying to work out what it is that the market will be satisfied with in terms of some kind of policy U-turn, how large a U-turn they need to do on one of those or more of those unfunded tax cuts that they had proposed. Now, I spoke to a guest earlier. The IFS, of course, says there's a hole of £60 billion in the public finances as a result of these. I asked a guest earlier, so do they need to find 60 billion then of U-turns? And the answer was, well, the number might be one thing today, it might be a different number next week. How are you looking at what the government is going to do here and whether it will be, quote unquote, enough?
Well, let's put it this way, nothing will be enough, and because institutionally the market's view of UK policy making has changed. It has derated. Let's be clear on this. Even if the entire budget, lock, stock, and barrel, if the entire budget were abandoned, we probably wouldn't get sterling back to where it was. We're not going to get a doubling in the number of mortgage products back. So that point, the risk premium on UK assets, that's in place. So to erode that, I think needs a longer term strategy. In the short term, however, there are reports suggesting only the national insurance cut's going to be maintained, and even using the IFS numbers, that can be offset using wage earnings for the benefits uplift, right? The benefits up rate. But politically, that's probably quite toxic as well. So if they can scale it back down to say under £20 billion or something like that, it is manageable, and I think the gilt market will calm down as well. But that doesn't unwind the institutional damage.
The institutional damage. Okay, that's an important point, Jeffrey. Let me ask you then, come Monday, if we see substantial U-turns over the weekend, if we see that coming to pass, will the gilt market, I know a lot is unknown as I say that, a lot will depend on the detail, but can you foresee a situation where the gilt market is able to stand on its own 2 feet without the involvement of the Bank of England in the way that it's been involved this week?
I certainly do, and I think the Bank of England, would have been calling pension funds, would have been speaking to LDI associations throughout the last 2 weeks. I'm just really checking how much exposures are. So I'm pretty confident, that they do have the situation under control, and never rule anything out. Backstops, there can be new liquidity backstops as well. But if we take a leaf out of Draghi's, the strongest backstops are the ones that never need to be deployed. Right? So with the new liquidity arrangements, perhaps that's designed as such. If further down the line more is needed, the Bank of England will never jeopardize financial stability. Let's be clear on that. But yes, on Monday, I do think the gilt market can hold its own.
Jeff, finally, to circle back to something you mentioned earlier, the question of China, a headline just crossing the Bloomberg terminal, the offshore yuan now at 7.21 to the dollar. That is record weakness for the offshore yuan ahead of the Party Congress that starts this weekend. What are the greatest market risks around that event?
So there are upside risks and downside risks, right? And I think there are more upside risks at this point. Look at the conditioning for zero COVID throughout the week. It's just article after article in the leading papers saying zero COVID is here to stay. But if there are very subtle hints of changes in what kind of a policy environment, what kind of a COVID environment, both for the pandemic but also for the virus, then I think that would be taken as a strong signal as well. But on the other hand, I think markets will also be looking at the makeup of the new leadership group. There's strong expectations there'll be a strong technocratic element, within the new bureaucracy, the new hierarchies. If, let's say, the share of technocrats is not as strong as previously anticipated, I think that's one area for markets, for international observers to reassess as well. So quite a few moving parts. It will take a few days, and ultimately, let's see what the lineup is next week.
Jeff, thanks so much. Really good to see you. Jeffrey Yu of BNY Mellon. Coming up on the programme, earnings season, we've mentioned it a few times, the banking sector in focus today. It kicks off today with 4 major US banks reporting. We'll get an update, a briefing on what to expect next. This is Bloomberg.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become Chief Future Officer, like Marriott's Leni Oberg.
One of the most important things is looking around the corner.
Adrian Mitchell from Macy's.
We have to let go of the traditional legacy department store.
And Luca Zaramella at Mondelez.
We tend to believe that all consumers are equal. They are not.
Look for Chief Future Officer on Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons in New York with Anna Edwards in London. Matt Miller is off today, and he's missing the debut of earnings season. U.S. banks will be kicking things off today with J.P. Morgan, Citi, Wells Fargo, and Morgan Stanley all set to report. Investors will be paying close attention to their outlooks as the Fed tries to fight inflation without derailing the economy. Allison Williams, Bloomberg Intelligence senior analyst for global banks and asset managers, is joining us now, up early for us, even though clearly, Allison, it's going to be a very, very busy day for you with 4 of these guys reporting this morning. A lot of headwinds that they're facing. Where do you think we could see the most pain showing up for these banks?
Well, I think it's probably not pain, but it's expected pain. And so what we're really looking at is what are the banks going to tell us with their loss provisions? Because it's going to be a great quarter. Net interest income is going to be really strong. Fees are going to be weaker. That's been well broadcast. So there is some offset there. But the question is really next year, what is the economy going to look like? And that's why we're looking to the loss provisions, because credit is going to be strong. We heard Brian Moynihan yesterday and, in the all recent weeks saying how strong the consumer is. We consistently have been hearing that from bank managements. But the loss provisions look ahead. And so to the extent that the probability has increased that there's a recession, and depending on the depth of that recession, that will be reflected in the numbers.
Well, and clearly the recession will ultimately be brought upon by higher interest rates, which can help the banks in many ways, but there's also areas in which it hurts, like mortgages. It's near 7% in the U.S. now. That could turn off a lot of people from buying. Who's most exposed to that?
It could. Well, the banks really have, over time, reduced their exposure to that business. So mortgage banking, which really focuses on the origination of loans and servicing of those loans, it used to be Wells Fargo, J.P. Morgan, Bank of America. They really had a huge hold on that market. But if you look, since the financial crisis, they've really cut different parts of that business. There's parts of the business that have a lot more regulation, so they've sort of gotten out of those parts of the market, and so they're really much less exposed. Wells Fargo, on a relative basis, still is much more involved in that business.
Alison, good to see you. So with investment banking and the fees that it generates very much in focus as part of the narrative that you just set out there, is that going to set up a contrast between what we're seeing from Main Street with resilient consumers, at least in the short term, and then Wall Street on the other? Depending on the bank's reliance on those two streams, are we going to see different stories?
I think that's exactly right. So if we look at Goldman Sachs and Morgan Stanley, we're going to see very steep revenue declines from a year ago. Both banks are very capital market focused. Goldman a little bit more tilted towards trading, Morgan Stanley towards wealth management. But we're going to see the biggest revenue declines there, whereas J.P. Morgan, Bank of America, Citigroup, and Wells Fargo, among the banks I cover, are more exposed to interest rates. They're going to do much better. And then the regional banks, which are covered by Herman Chan, those really are going to benefit from the higher interest rates. Loan growth is slowing a bit, but there still is some loan growth. And provisions, as I said, we're looking towards the future, but credit is pretty strong right now.
Yeah, and so tell us, what should we look for more specifically then, Alison, when it comes to that push and pull, I suppose? Net interest income, of course, helping at this point for some of these retail banks, but on the other hand, concerns about whether their consumer base can stand up to recession. It means that the share prices respond in an interesting way sometimes to higher rate expectations. What will you be looking for there?
So I would say in terms of the more regional banking side of the business, if you will, the questions are going to be what's happening with the cost of deposits. So we can all see the benefit of higher rates. I think that has really factored into the numbers, but the two questions are, one, how fast are deposit costs going to rise as a result of that? And then number two, what is the impact on loan growth, right? So it's great that we have higher rates, but at some point there's a tipping point. Loan growth has started to slow. What is the outlook for next year? What are the demand trends? We have really great consumer spending, probably going to see that for the next quarter, but how are we thinking about next year? And then for the investment banks, the strong story is going to be fixed income trading. So volatility, as you said, the fees are really down significantly. There's been a dearth of IPOs this year due to the volatility. The offset is we're going to have very strong fixed income trading. That's a positive. Again, it's all about the outlook. That investment banking business, what's happening with the pipelines and execution, things have been stalled for several months now. Will those deals be able to get done? Will they push into next year, or are we starting to see things start to get pulled? That's going to be the question on the investment banking side.
All right, Allison Williams of Bloomberg Intelligence, thank you for joining us this morning. Best of luck digesting these 4 bank results today. Thank you so much. And later today, we're going to be hearing from the CFO of Wells Fargo on his bank's results. That's at 4 p.m. in New York, 9 p.m. in London. And meanwhile, Anna, we have some breaking news out of the UK.
Yeah, we do. According to our reporting here at Bloomberg, the UK Prime Minister Liz Truss is going to reverse some economic plans later today, later Friday. So this just giving us a bit more detail on the timing. We wondered if we'd have to wait for the weekend. Well, now it seems that we are going to hear something of this today. How much Kwasi Kwarteng, the Chancellor, knows about any of this is uncertain. He has been coming across the Atlantic over recent hours. Perhaps he has connectivity, we'll see. But his plane yet to land at Heathrow, it's been taken on every twist and turn you can imagine, and that Heathrow landing, that holding pattern that many of us will be very familiar with. So he waits to land at Heathrow and to find out and to weigh in, of course, and discuss how policy moves forward here in the UK. Meanwhile, the pound at 112.66. This is Bloomberg.
Stronger that moment that you're lifting the barbell. You get stronger as your body is making repairs, making recovery. Recovery is a when and how you get fitter, faster, stronger.
Recovery technology includes everything from massage guns and foam rollers to compression boots, hyperbaric chambers, cryo chambers, infrared saunas, and even infrared pajamas. And athletes are partnering to become investors to take those products mainstream.
When you look at tech in sports right now, it's completely innovating the way training's going, completely changing the way recovery's going. I think sky's the limit as far as where it can go.
But while some of these products can feel amazing, it can be difficult to differentiate between what really helps the body and what just tricks the mind.
Every time you're chasing the latest, greatest, newest tool, you're probably chasing a mirage.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons in New York with Anna Edwards in London. Matt Miller is off for a long weekend. But before we can get to the weekend, we still have to get through a very busy Friday today. Here's what those events include. The Bank of England's emergency bond buying program is set to end. We have discussed that at length throughout the program. Plus, starting in just about an hour's time, U.S. bank earnings will be kicking off with J.P. Morgan, Citi, Wells Fargo, and Morgan Stanley all reporting. We'll also be getting some economic data with U.S. retail sales at 8:30 a.m. New York time. And finally, happening this weekend, China opens its 20th Party Congress on Sunday, where President Xi Jinping looks set to secure another term as party chief. And the markets, Anna, are going to be watching that one very closely.
Yeah, absolutely. And pessimism is running high for China's economy heading into these important events, which are set to take place over the weekend. It's a twice-in-a-decade party congress. Investors looking to the leadership gathering to steer the nation out of the current economic slump. Bloomberg's Tom McKenzie joins us here on set in London to talk us through the latest. And Tom, let's start with what we should expect overall, I suppose, from this party congress. What are the key things we're going to be watching for?
Well, just for the context, this is one of those rare moments where you get an insight into the Communist Party of China's thinking. So that's the importance, as you say, every 5 years. The big speech from Xi Jinping on Sunday. And as you say, at a time when we've had a torrid year for Chinese assets and, of course, the economy as well. So the benchmark, the CSI 300 is down about 22%. The yuan is down about 11% versus the dollar. And then the economy, the World Bank thinks the Chinese economy will grow just 2.8% this year for the first time in more than 3 decades, below most of its Asian peers and below that 8.1% that we got yesterday. Last year, I should say. That again, within the context, you're looking back to the kind of growth we saw in the 1990s when China's economy was a minnow. So what we're looking for, of course, any comments from Xi Jinping around the ability to shore up growth, but also the lineup as well. At the top of the party, the most powerful men, they are all men, unfortunately, at the Politburo Standing Committee, because that will give us a sense, that lineup, as to how entrenched Xi Jinping's own power is, and what that can tell us then about the tensions that we know exist between the need to reform, stabilize growth versus the focus on security and the borders of China.
Well, Tom, you talk of stabilizing growth, and we know one of the biggest challenges to the Chinese economy has been the standing by of COVID-0 policy. They have not abandoned that policy despite its detrimental economic impact, and it seems that state media are talking up the idea that that needs to continue even after the Party Congress is over. What about that?
Yeah, absolutely. This will be, as you point to, a big disappointment for investors and for those hoping that you're going to get a major relaxation around COVID-0. You're absolutely right. We've had at least 3 days where you've had commentaries in state newspapers supporting COVID-0. You've also had the hiring of COVID-0 officials in Shanghai on 2-year contracts, which, of course, many people are reading into in terms of the time frame. A number of people think it's not going to be relaxed significantly until at least the second half of next year. So that is a major hindrance. And in fact, you've seen a flare-up of COVID cases. And in the case of Shanghai, a number of schools and other businesses have been closed down. Any commentary on that we'll be looking for as well, but there is not an expectation you're going to get a dramatic change on COVID-0. Also looking for anything on the property sector. We've been talking about the headwinds facing that sector. There have been some measures to try and put stimulus into the real estate market. A lot of that will depend on COVID-0 as well, but anything that's incremental will be looked for on that front. And then, of course, US-China tensions. We saw those additional restrictions on tech shares, or at least chip sales into the Chinese market. What the Chinese responses can be if they double down on spending on R&D, for example, will also be closely scrutinized.
Okay, Tom, thanks so much. Bloomberg's Tom McKenzie with the latest on what we should watch for at these important Chinese meetings. Kaylee, we should just take a moment to reflect on what we've heard about the UK this hour and what we still yet to hear. We had confirmation then from our reporting that we are going to get some kind of U-turn on fiscal policy today. It is going to come today. We aren't going to have to wait for the weekend. And interesting that the Times newspaper in the UK is reporting that will involve plans to freeze corporation tax being reversed. And that has been widely anticipated as one of the moves that they could do to go back on their mini budget. The problem, though, Kaylee, is that that's worth about £18 billion. And the IFS, the Institute for Fiscal Studies, says the hole in the budget is £60 billion. So whether that's enough, whether other measures will follow, is going to be a key question.
Absolutely. How ultimately is all of this going to be paid for, Anna? And it strikes me that they are going to make these U-turns today as we see the ending of the BOE's emergency bond buying program. That today is the last day of that. Andrew Bailey has made that very, very clear. So a lot for UK assets to consider. The 30-year gilt yield right now down 20 basis points on the day, Anna.
Yeah, absolutely. So the gilt market has been responding to expectations of a U-turn, and the pound actually was a lot stronger yesterday on that same expectation, a little bit weaker today at 112.43, but we have seen expectations of U-turns building in the markets daily in recent days. That is it for early edition. Surveillance is still ahead. This is Bloomberg.
Should we anticipate that you will have regulations clarifying what the SEC is going to do on cryptocurrencies and related kinds of things in the near future?
It's pretty clear that many of these tokens may be securities. What we've asked the trading platforms, the lending platforms, the other various venues to come in, to work with us, to get registered under the securities laws, because if a platform has 50 or some of them 500 tokens on their platform, probabilities are they're not all non-securities.
Now, there's another issue that has arisen, which is called gamification, which is to say people are making a game out of trying to buy stocks. Are you worried about this phenomenon?
We live in the 2020s in a new digital age where applications on our phones can use massive amount of data and then predict our behavior. What do we do when the digital algorithms are maximizing for the company's revenues rather than our returns? And so we're trying to think that through. It's not just gamification, it's a little bit more than that. It's whether there's a conflict between the app and our investment returns.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology.
Welcome to Bloomberg Crypto.
Fiscal and monetary policy appeared to be moving in completely opposite directions.
The Bank of England is having to try and manage the chaos that the government has been creating in the bond market.
The bond market vigilantes are back.
What we've had in the UK really is symptomatic of what is happening elsewhere.
For the Fed, they're strapping themselves in for this. They're sort of expecting some increase in volatility because the world is uncertain.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Bramo is going to explain what happened yesterday. I've got no idea. Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio. Later this hour, JP Morgan kicking off bank earnings here on Wall Street. Bramo, should we start with yesterday?
Yes, let's.
Would you like to explain yesterday for the audience worldwide, please?
People say it was technicals because they have no other explanation for it. That basically some people saying that it hit the point of a 50% retracement since the gains of the post-pandemic.
Sure.
And that was suddenly a buy trigger for the algorithms. Say what you want to do. It's a messy market. Where is the compass for what's actually meaningful in a market that makes no sense?
Jordan Rochester of Nomura with a quote at the top of his note this morning. It reads as follows: if it doesn't smell right, it probably isn't.
Yes, I love
That's
that.
how a lot of people felt at the close yesterday. The 2-year through 450 in yesterday's session. Now, typically, if you tell me where the bond market is, I can guess where the equity market finished. That wasn't the case yesterday. Yields responded in the way we expected them to respond to that CPI print. The equity market did not.
The equity market was one of the only markets that did not respond in the way that you would expect it to respond. I think that's notable. You saw the dollar gain. You're seeing the dollar continue to gain today anyway. You saw, although briefly you did see some stability in terms of the dollar globally, which perhaps some people said also could have been the trigger. I'm not going to speculate. But still, you are seeing in March, the terminal Fed funds rate 4.9% is what's currently priced into the market. To give you a sense of how aggressive people are pricing in this Federal Reserve, I'm not sure where the optimism is that we saw this massive U-turn in markets.
So the attention shifts this morning. We'll go away from CPI for a moment. We'll go through the bank earnings, retail sales a little bit later. Got to talk about the UK as well. Chancellor Kwarteng's no longer in DC, on his way back to the UK. I understand he might have landed in the last few minutes or so. The UK's Prime Minister, Liz Truss, according to our reporting, is set to reverse some of the economic plans later today. Never mind in a couple of weeks' time. This could happen later today.
My favorite articles about this are an explanation of when reporters saw Andrew Bailey in the hallway and said, "What's going to happen today?" And he just smiled. You know, I mean, he kind of knew. And how much did he win, right? I mean, who was going to blink? He didn't blink. And not only that, but in some manner, he is actually forcing fiscal discipline on a government that did not want to behave or adhere to what the market was saying.
We'll head down to Washington in just a moment to catch up with Tom Keene down in DC to get the latest on a lot of this. Right now, futures are negative by only 0.2%. Setting the tone early on this morning will be JP Morgan. Then we'll run through all the earnings in just a moment. Then you've got retail sales a little bit later. Look at the bond market. Yields come in today, but I can tell you on the week, for an 11th consecutive week, the 10-year yield is climbing higher. On the session, we're down about 4 basis points or so. Lisa, 390.55.
Yeah, the CPI data was not comforting for anyone, particularly with respect to core, with it coming in at the hottest level in 40 years. As you said today, bank earnings very much in focus, not just for the banks, but as a kickoff to the overall earnings season. How well are consumers hanging in there? And is this a good thing or a bad thing? Year to date, you've seen a real varied performance across the board in terms of which banks have performed. You see JP Morgan down more than 30%. Yesterday, I just want to point out, yesterday you saw a massive gain in all of these shares. Again, why? I'm not sure. Again, try to make a narrative out of this. Good luck to you. I'm not going to do it. But down the line, you see Wells Fargo down only 12%, perhaps because it didn't have as far to go. Morgan Stanley down 20% year to date, and Citigroup down nearly 30%. Also today, September retail sales at 8:30 a.m. Our consumers continuing to spend. It's going to be messy because of what happened with the hurricane down in Florida, and University of Michigan October Sentiment Index at 10 a.m. It's mattering again. I expect this to actually be significant, and I can see your face, John.
I'm just smiling. I'm just happy it's Friday.
Because you're like,
I don't want to ever hear.
I don't ever want to hear about the University of Michigan survey. Again, I'm curious to see whether you start to see it roll over a little bit, just based on what we're seeing with respect to gasoline prices starting to tick up again. And today we do have a bunch of Fed speak.
I care about Fed speak today.
Okay.
First reaction to CPI. Governor Waller and co.
Yep, Kansas City Fed President Esther George, Fed Governor Lisa Cook, and Fed Governor Chris Waller. Really? You're interested? What do you want to see?
I want to see what Governor Waller's got to say about that print. He's been pretty hawkish on the board. I think he's been a bit of an outlier in some sense, but a lot of people have had to catch up with his view down in DC, and I wonder if he pushes it even further. For me, yesterday wasn't about the November decision. It was about the news conference with Chairman Powell. Could he lay the groundwork for a downshift in hikes from 75 to 50 to 25? Going to be really difficult now. How do they set the stage for December? These guys wanted a string of decelerating inflation prints to give them some kind of convincing idea that maybe we're heading back towards 2. They're not getting it.
Well, and right now, that's the reason why you're getting a nearly 5% terminal rate being priced into Fed funds futures. How much is that going to go above that as you start to see some of these sticky components? Did you see the sticky component of the CPI? That increased at the most going back to the 1980s. So it's not just sort of the temporary aspects, the sticky aspects that are going to persist.
Did you see the administration? They now want you to include gas prices. Went through the summer and last year, they wanted to strip out the bits that
and they emphasized the headline rather than core, and earlier in the year they emphasized core over headline. How do you feel about
politicians just drive me nuts.
No one knows that.
Here's a headline out of the UK. Our reporting: Liz Truss, the Prime Minister, hold a press conference on the UK economy later on today. Down in Washington, D.C., at the International Monetary Fund, is our good friend Tom Keene. TK, the Chancellor's no longer there. I know you had eyes on the Governor a couple of minutes ago. Set the scene for us down in Washington as we look ahead to the UK and what's about to happen in London a little bit later.
Without question, the most interesting meeting since 2008, John. Absolutely extraordinary. John, let me paint quickly here because of time is short. the picture yesterday. I've got the Bloomberg on my iPhone, and I'm showing the managing director of the IMF the 11 basis point move in the 10-year real yield out to 1.69. She and her entourage were silenced. This is before our discussion. As we did this, John, behind us was the chancellor setting up for his interview with the BBC, which again moved the markets there before he exited across the Atlantic Ocean. That's the movement here that's very fluid. We'll speak with Ragarajan of Booth School and, of course, his extreme expertise on emerging markets and his India. And Geeta Gopinath will join us as well. You know the first questions on inflation.
Looking forward to it, Tom. Just a final question for you before we catch up with you again later on in the show. Mohamed Al-Arian started the conversation this week, and he said we've got a global problem that requires a global solution. Do you get the sense that we're heading in that direction down in Washington this week?
This is the heart of the debate. I was having a beverage of my choice yesterday, John, and this was the key thing, the word accord from John Lipsky. John Lipsky does not see the elements of accord that are necessary to get that global solution. It's a Bremer meeting, John. It's every nation for itself.
Hey, Tom, great word this week, sir. As always, good to catch up, buddy. Tom Keene down in Washington. We'll catch up with TK a little bit later. We're not getting that global solution to a global problem anytime soon, are we, Lisa?
We knew that, though, right?
Sure.
I mean, nobody was going to say that we were going to get that until the pain really starts to feed into the U.S. And right now, if anything, it's helping, at least when it comes to overall inflationary pressures.
That's why I'm curious about retail sales a little bit later. Does that just confirm that story of underlying strength that this Fed just needs to do a whole lot more?
My concern is, and this is somewhat nuanced, I'm not going to get into it right now, is that you are seeing the upper income individuals and households continuing to spend and spend even more. Lower income, much more constrained. You're getting very different stories depending on which bracket you look at.
Joining us right now is Margie Patel, Senior Portfolio Manager at Allspring Global Investments. Margie, first question, unfortunately, it's the awful one I started the show with. What on earth happened yesterday?
Oh, I think it was a typical short-term traders rally. Even though the numbers were bad, you could look at it and say, well, here and there numbers would suggest inflation is rolling over, so maybe the Fed will backpedal and not be so aggressive. I don't think that's what the Fed is going to do, but I think that's what the market thought. And the market is really all about short-term trading swings, nothing about fundamentals. It's only about what is the Fed going to do and handicapping that.
Marky, how has your view changed over the past couple of months as you do start to get more of these short-term trading swings and you start to get read after read highlighting the persistence of this inflation?
Well, I think the market has been dominated by this very short trading swings from companies, from sectors back and forth reacting. Again, it all comes back to the Fed, people trying to handicap what the Fed is going to do. So it hasn't changed very much. I think that the Fed is guiding light, is basically looking at the unemployment rate, which looks terrific. So they feel they can continue to aggressively tighten, aggressively sell securities, and things are all right because the unemployment rate is low. And so I think that's why the market will once again overreach because it's looking really at that. Unemployment still looks good, and that's what they're going to focus on. And so no change. I think the Fed is going to continue to be on this path for quite a few months.
Does this mean that you're hiding out in cash?
No, I think that basically equities still look very attractive because maybe one day the Feds will say, well, we've done enough here, let's stand back, compromise with inflation in the interest of growing the economy. And also the very strong dollar, that says to me more than anything, that tells you the strongest economy in the world is manifested in the strength of the dollar. So I think the U.S. is still a good place to be. If you're invested, you'll be there in the bottom, which will come one day.
Hey, Margie. Great to catch up, as always. Margie Patel there of Allspring Global Investments, trying to make sense of the last 24 hours, and I think a lot of people struggling to explain what happened yesterday. I think the first 5 minutes made sense, right? That's the thing about this market. If you don't like the price action, wait 60 seconds.
I think
something
that's right.
might change for you.
Yeah, the explanations were kind of fun. I read through some of the commentary, and it basically was like, this is technical. The algorithms, they don't know anything. This doesn't make sense. Ignore it. Perhaps this is persistence. It shows that there's still money in the market. I mean, all of the explanations were basically don't listen to it. But then how do you position around that, right? How do you have a long-term view if short-term trading signals are not giving you information that is reliable? What is the ballast? What is the compass? And I really spent a lot of time thinking about that last night. Does it all come back to the dollar? Is that really the tail that wags the dog?
Sure. I think for a lot of people it is. The other question I've been asking at the moment, short-term versus long-term, is whether we've seen some kind of secular shift away from the old regime to I use the word permanent loosely, but you know where I'm going with this, to a more permanent state where you have higher rates, and higher inflation levels. And there's still a lot of people pushing back against that.
Although you are seeing, and not to get, super philosophical, the sort of...
No, get deep, please.
The deglobalization.
Nice.
And this question of reshoring is going to have a more persistent inflationary tilt that has not necessarily been factored into the secular kind of low growth, low inflation environment. And that, I think, is the key change.
That was super philosophical.
Thanks, I tried.
We'll get philosophical about the UK in just a moment. Your 30-year gilt yield is down 26 basis points. We'll catch up with a former chancellor who lived the mess of the early 1990s. That conversation up next.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Germany's defense minister says NATO allies must take Russian threats to use nuclear weapons in its war on Ukraine seriously, but should not let them disrupt international efforts to support the government in Kyiv. Russian President Vladimir Putin has warned that any nation that interfered in his invasion of Ukraine would suffer, quote, consequences that you have never experienced in your history. His comments widely seen as threatening a nuclear strike. UK Chancellor of the Exchequer, Kwasi Kwarteng, left IMF meetings in D.C. early to rush back to the UK. Prime Minister Liz Truss's administration is preparing to abandon a central part of its tax-cutting agenda. Truss has come under pressure for her own party to restore Britain's economic credibility after the fallout from their fiscal proposals. And U.S. House Speaker Nancy Pelosi said in a video shot during the January 6th insurrection that she wanted to punch President Trump if he showed up at the Capitol. A video released by CNN shows Pelosi in her office as the Capitol is about to come under assault. In the footage, Pelosi says, quote, "I hope he comes out. I'm going to punch him out, and I'm going to jail, and I'm going to be happy." Lawmakers want to question Trump about the 2021 riot and are demanding documents and testimony about his role. The move comes just weeks ahead of midterm elections that will determine control of Congress. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
To name a couple of your babies. I don't know if I'm asking you to choose amongst your children, but some of the most recognizable buildings by you, of course, the Millennium Bridge, London City Hall, the Reichstag, and the Great Court British Museum. What was your favorite project to do?
The Reichstag does stand out because, first of all, it's an energy manifesto. So it transformed something that was dependent on fossil fuels. It uses all the technology to produce something which is essentially carbon neutral. And as a public building, that's a statement. It's a symbol of a city. It's a symbol of a nation. It incorporates works of art. It's recycling an existing building, which, as I mentioned earlier, is the ultimate in sustainability. If you can give a new life to a building, it also creates public space at the roof level. It is the most visited parliament in the world, so it puts the public above the politicians who are answerable to them. And that, of course, was made possible by the politicians. So it's a demonstration of democracy in action.
When U.S. inflation numbers are released,
The score is inflation one, Fed nothing today.
Bloomberg brings you crucial data at terminal speed.
Core CPI in America, 40-year high.
Yields are absolutely flying.
Equities down and down hard.
It's ugly.
And instant expert analysis.
What is the makeup of this inflation?
We are watching the underlying fundamentals.
Will they go 100 basis points?
The downshift just keeps getting pushed out. Now it looks like we're going into extra innings.
Nobody covers the economy like Bloomberg, your global business authority. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question. Great question. Great question.
Great question.
Great question. That's going to be the best question I get all night. I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
So you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Our position hasn't changed. I will come up with the medium-term fiscal plan on the 31st of October, as I said earlier in the week, and there'll be more detail there. What I'm totally focused on is on delivering on the mini-budget, making sure that we get growth back into our economy. I'm not going anywhere.
I guess if you've done a 180 on the previous plan and you do a 180 again, that your position hasn't changed, right? Because you just go back to the old plan.
Doesn't really work like that in politics. Just gonna throw that out there. I think that there is some reputational damage along the way.
I think that's not what he's trying to say. That was the Chancellor in the last 24 hours. That Chancellor has landed back in the UK because the UK has had some problems over the last couple of weeks. Right now, the 30-year yield in the gilt market is down by 25 basis points. The Telegraph in the UK reporting the following, that the Prime Minister Liz Truss will hold a news conference at 2 p.m. today. And this is the line I think that's going to get a lot of interest. The corporation tax will rise to 25% from 19%. Lizzie Burden outside of the Bank of England and outside of number 10 Downing Street for us in the last couple of weeks. Right now, outside number 10. Lizzie, let's start with number 10 and what's about to happen a little bit later.
Well, it's a complete U-turn here. They're going back to Boris Johnson's plan to raise corporation tax from 19% to 25%, giving up one of the main planks of Trussonomics, which was intended to boost growth. And it became inevitable yesterday when the markets priced it in. Of course, Kwarteng rushed back from Washington in the early hours. It's been compared to when the Greek finance minister left the G20 in 2011, although his allies have shunned that comparison. And really, in the game of chicken between the Chancellor and the BOE Governor Andrew Bailey, it seems to be Kwarteng who's blinked first. Bailey looks like he can uphold his promise to end the BOE bond buying programme today. But we are expecting this press conference from Liz Truss later on and they will hope that it will calm the markets.
One source's comment was, people are petrified of the markets. I was reading this yesterday in the Financial Times. Lizzie, how much is this entirely a market-driven response where they are trying to calm a market when Andrew Bailey is backing away and gave the government 3 days? Yes, he was also giving perhaps pension fund managers 3 days, but really it was the Truss administration.
Exactly, and Mark Carney, the former BOE governor at the IMF, said that bad policy would be punished by the markets, and yet again, Kwasi Kwarteng and Liz Truss are having to learn that lesson. It may just be the second of many more U-turns, because of course the government needs to plug a £60 billion hole in the public finances. That's according to the Institute for Fiscal Studies estimates. She's already said this week that she's not prepared to cut public spending, although there are hints at efficiency savings, and we all know what that euphemism means. But even if they reverse this corporation tax freeze, it's still not going to plug the £60 billion gap. It'll save about $13 billion a year. So there's much further to go. And then you have to ask,
what's the point of having Liz Truss if she can't get the central planks of Trussonomics through? She's a Prime Minister who's in office but not in power. And today the Times is reporting that the Tories could change their rules so that she could be replaced with Rishi Sunak and Penny Mordaunt, who of course ran against her to be the leader. But whoever took over from her would have a seriously diluted mandate, and they'd be therefore pressured to call a general election. And by the looks of the polls at the moment, it looks like Labour would win.
Lizzie, thank you. This one's a struggle to keep up with, isn't it? Lizzie Burden outside number 10 for us. I thought this morning we'd be talking about the Bank of England and the expiry of the gilt market operation, Lisa, but the attention firmly on the other side of London.
Yes, because basically Andrew Bailey won, and they are going to give some credence to this. How much then do we see yields continue to come down, and will this be enough?
We'll see. Let's catch up with the man who lived the mess of the early 1990s, the former UK Chancellor, Lord Norman Lamont. Lord Lamont, fantastic to catch up with you, sir. I want to borrow the words of Lizzie Burden, my colleague there. Do we have a Prime Minister in office but not in power?
I beg your pardon, I didn't hear that.
Do we have a Prime Minister in office but not in power?
Well, that is a quotation from myself, that phrase, in office but not in power, which was a phrase I used to describe the position of the major government. I think probably we do have a situation like that because it is deeply humiliating what has happened. It is a real mess. I hope that what is about to be announced will calm the markets, but I'm rather skeptical about it because it is only a part of the package that needs to be reversed. I think you either have to have public expenditure cuts or all the tax cuts will have to be reversed. It is really a very, very awkward situation and a very humiliating situation.
Lord Lamont, given that you think that perhaps a full reversal could, but may not, really give some more credence to this administration, do you think that there needs to be a new administration, new leadership to this particular parliament?
Well, I think that's up to members of parliament. What we definitely need is stability. I think MPs need to be conscious not just of whether the Conservative Party can recover in time for the general election, but we need to remember that this is being watched by the world and this is not a very good advertisement for the country.
How concerned are you about the pound, given the structural damage with respect to the U-turns, or can we even call them U-turns, maybe switchbacks, from this administration?
I'm sorry?
I'm wondering
I'm sorry,
let's leave it there. I appreciate your time. Lord Lamont, it seems like our connection has gotten lost. Lord Norman Lamont, thank you so much. But John, really, this highlights the concern at a moment where it's very difficult to really understand how they can restore credibility with the pound, with markets that are incredibly skeptical of their plans.
Unfortunately, we lost the former Chancellor there because this is a man who lived it in the early 1990s when sterling dropped out of the ERM. The question that we've been asking is whether there will be scars left on sterling-denominated assets where you'll have to bake in some kind of risk premium, not permanently, but perhaps for a period of time, because this is playing out now and maybe they have a U-turn, but have they completely lost credibility, to your point, whereby that even if they unwrap and walk back all of this stuff, that the Bank of England still needs to do more than it otherwise would have had to do when it meets in early November.
But is it the Bank of England or is it this fiscal administration, right? And I ask this because the Bank of England, some people would say, comes out looking better than anyone in this environment. They didn't go that big, right? They did this emergency program to kind of plug the gap, but they haven't U-turned on the quantitative tightening. They're continuing to go with their rate hikes. On the flip side, how much has to be done with respect to policy that might not have had to be done? To your point, more fiscal discipline than they even would necessarily have had to do in order to restore credibility to the pound.
This has been a mess. The UK's been a focal point for the last month or so, but we know we have a global problem here. This has been a global story where the dollar has been immensely powerful and strong. Yields have been climbing all over the place. And when I asked the question earlier this week, of course, I had my own answer to it. What surprises you more, what's been announced or how the market responded to it? For me, it's how the market responded to it. To see this market this fragile in response to £45 billion worth of tax cuts is pretty amazing.
And if you flip it on its head, how much is what just happened a symbol of the fact that monetary policymakers are going to be able to inflict discipline on the fiscal authorities?
I think we're seeing that this week, aren't we? In a big way. We're going to catch up with Gerard Cassidy, the head of US Bank Equity Strategy at RBC Capital Markets, a little bit later this morning. JP Morgan numbers just around the corner.
very transparent to the shopper before they accept an order, what the order is going to look like, how much we're going to pay them, and how much like the consumer is paying them. And so they can decide whether they take an order or whether they refuse it. And that's the kind of flexibility that our shoppers really value and the kind of transparency that they want.
Are you seeing a labor shortage right now? And what are you doing to combat that?
It's different in different places. Our demographic of shoppers is completely different from food delivery and ride sharing. We're 70% women and half of them are moms. And that's because a lot of the job at Instacart is very different than just being in a car with strangers. It's about like going to the store, doing a good job of customer service, of really picking the right products for the consumer. And we are seeing that being very appealing to women.
Part of what I love about business is you get to build things from nothing.
I don't have any investors. All this is all money in. This is me just building it.
It's pretty much full service shadow banking with nobody in charge.
Here's some news for you from Stephen Swinford of The Times, the political editor in the UK. I'm told that Kwasi Kwarteng is being sacked as Chancellor as Liz Truss prepares to reverse the mini-budget. Not clear who will be replacing him. Events moving very, very quickly this morning. Number 10, not commenting. British politics is absolutely brutal and severe, and you're about to see some of that play out today, possibly.
Especially with the finger pointing of who takes the blame for this. Can Liz Truss preserve her reign by basically throwing Kwasi Kwarteng under the bus?
Couple of weeks on the job. This comes from the political editor of The Times in the United Kingdom, out of London, exclusive. I'm told that Kwasi Kwarteng is being sacked as Chancellor as Liz Truss prepares to reverse the mini-budget. Outside number 10 Downing Street, Lizzie Burden. Lizzie, the headlines keep rolling in.
I don't know if you just caught the look on my face, John, but this is a huge moment for Liz Truss because Kwasi Kwarteng is one of her close friends, her neighbour in southeast London in Greenwich, and her political soulmate. Over the course of the past 12 years, they've been joined at the hip. They wrote together Britannia Unchained, this manifesto calling for tax cuts and deregulation. That was the blueprint for this budget that today we find out Truss is going to announce she's going to reverse huge swathes of, and it leaves her an extremely lame duck in office but not in power, and you have to ask how much longer she can cling on to power. The Times has also reported today that the Tories are going to change their rules so that she can be replaced with Penny Mordaunt and Rishi Sunak, but if either of them took over, they'd still have a severely diluted mandate, and there'd be massive pressure for an election.
Lizzie, I'd love your thoughts on what we understand so far. We started this reporting yesterday that we'd get some form of U-turn from the budget announced just a couple of weeks ago, the fiscal announcement. Can you tell me how much of that is actually going to get walked back? Is it just the corporate tax component of it, or is it everything?
Well, the Financial Times is reporting that it's going to be even more of it, and it would make sense because Truss has said in Prime Minister's questions that she's not going to make spending cuts, which of course would be difficult in the first instance because George Osborne as Chancellor picked most of the low-hanging fruit under austerity, but also politically ugly in a cost of living crisis. There was also speculation that she would try to raise benefits only in line with earnings instead of inflation to try to incentivize people back into work. But again, ugly, because on the main form of welfare, universal credit, 38% of recipients are in work. And again, we're in a cost of of living crisis. So if you put the spending cuts aside, it leaves U-turns on the tax cuts. We've already had the massive U-turn on the top rate, then corporation tax seems to be the next, and then you've got the rest to come today. But really, as I say, what's the point of having Liz Truss in number 10 if Trussonomics can't get done? But wasn't it always inevitable, given that she was, yes, the party membership's choice for leader, but not MP's choice, because they actually wanted Rishi Sunak. But what's pushed her to this point is the markets. And as Mark Carney said, the markets will punish bad policy, and finally, she's learning that.
Can Liz Truss blame Kwasi Kwarteng entirely for this?
No, because, as I say, they have been joined at the hip throughout. These are her ideas. You can see the roots of these ideas in her writings over the past few years. There's no surprise that this is what Liz Truss wanted to do. She told us day in, day out throughout the leadership campaign that from day one what she was going to do were tax cuts. And they have gone down so badly with markets. I mean, the other problem of why this hasn't been able to have market credibility is because they have outcast Tom Scholar, the top civil servant at the Treasury. They have sidelined the Office for Budget Responsibility, the fiscal watchdog, and throughout Kwasi Kwarteng's time as Chancellor, he's been almost flippant about the markets. Remember, he said that they'll react as they will. Other ministers, him included, have said that what's going on in the markets is due to the international context, the war in Ukraine, Fed hikes, dollar strength. But anyone with a Bloomberg terminal can see that there has been a particular Kwarteng effect on top. But as I say, it's not just a Kwarteng effect, it's very much also a Truss effect, and that leaves the problems even if she cuts out Kwarteng from the picture.
Hey, Lizzie, great work, great reporting. Lizzie Burden there, outside number 10. What did James Carville say? I'd come back as the bond market.
Yeah, exactly.
This bond market's back in a big, big way. We've heard it from a few guests, including Mohammed Al-Arian this week, on this programme and in a Bloomberg opinion column. The vigilantes are back. And the vigilantes have claimed a couple of names already.
And basically, who's next, right? And at what point will you see this start to impose some sort of restriction in terms of how much debt a number of different nations sell? I also want to raise, though, that this comes at a time when you have a lot of nations that want to plug fiscal gaps by selling debt. I'm thinking of Germany in particular. So this is a real tension, especially when some of these expenditures are considered necessary.
So we've had the reports. We want the news now, don't we? We've had the reports that we'll get this news conference a little bit later at 2 p.m. in the UK. We've had the reports from the Times this morning that the Chancellor is going to get sacked. Now we need the news. I said to Lizzie, I want to understand how much of that budget actually gets walked back. Is it just one component of it, the corporation tax, or is it everything, all 45 billion sterling worth?
Right. So in other words, if they don't walk back everything and then the bond market revolts, do they then have to walk back more and fear losing even more credibility in the process?
I suspect that's not the situation they want to be in.
Exactly.
In a week or so. Yields right now down about 25 basis points on a 30-year to 4.29. A little bit later this morning, we'll be focusing on one thing, bank earnings. JP Morgan is just around the corner. Gerard Cassidy joins us right now, the head of US Bank Equity Strategy and Large Cap Bank Analyst at RBC Capital Markets. Gerard, let's go there first of all to JP. What are you looking for from Jamie Dimon's big bank?
John, I think what we have to look for is obviously how are they doing in their investment banking and capital markets businesses. But more importantly, since those numbers have been guided to by many of the big banks and the investment banking business, revenues could be down as much as 50% year over year. Trading revenues could be flat to down. But it's the net interest margin. As you know, you've been talking about it all morning about interest rates. The rise in the Fed funds rate has been very favorable to JP Morgan and its peers as the margins have expanded. The other thing we've got to watch very carefully, though, with JP Morgan is their capital levels. Those rising long-term interest rates have hit their bond portfolio. As a large GSIB bank, this company has to take that unrealized loss not only for their GAAP capital, but their regulatory capital. That will be another point that we're going to focus in on. And then lastly, of course, the loan loss reserve buildup. Under CECL, current expected credit loss accounting, they're going to have to build up that loan loss reserve this quarter.
Gerard, I'm curious to understand exactly the context that Jamie Dimon was speaking in yesterday when he said, I don't know if it could be a soft landing, talking about the U.S. economy. I don't think so, but it might. He said in a tough recession, you could expect the market to go down another 20 to 30%. Gerard, what's the signal from these sort of dire proclamations from the CEO of J.P. Morgan?
I think what we're seeing is obviously based on history, this type of action by the Fed would lead to a slowdown/recession, as he pointed out. And we have some history, of course, back in the 80s when inflation was like this. And none of us have been in that market, trading and looking at stocks in such a high inflationary period. So it's really unusual. The other unusual period here is what they did during the pandemic. I like to say that they threw the economy off kilter with all of that stimulus, and we're still off kilter. So there are many cross currents going on right now, and we see that with the economic numbers that we look at on a daily basis.
Gerard, looking forward to breaking down these numbers with you. Gerard Cassidy there of RBC Capital is going to be with us in just a moment on the JP Morgan numbers. I think you asked a brilliant question, and you're right. What Jamie Dimon says about the macro situation in the US economy, is that a man who sees the same situation in his bank right now? Or is that just an independent thought about where we're going?
But that's really what's key in terms of interpreting this particular proclamation, a 20 to 30% additional decline in U.S. equities. You can imagine freezing up in the credit markets, in the IPO markets. You're already seeing that to some degree. What does that mean for their revenues? How can he generate enthusiasm to go out there and do banking at a time when he's experiencing or expecting to experiencing something quite negative?
My head's spinning this week, and it's spinning if you're just looking at the UK as well right now. Guy Johnson has just ran over to a camera for us in the city of London. Guy, great to catch up with you, buddy. Let's just start with what you're expecting to hear at 2 p.m. local time, a little bit later.
It's going to be a big U-turn. I don't think we'll get the details. Maybe we won't get the details today of exactly what the U-turn does look like in terms of the ultimate tax policy here. We have a pound that is responding to a tweet from the Times suggesting that Kwasi Kwarteng is likely to no longer be in post. It looks like his decision to rush back may have been to find himself with an announcement that he is going to be leaving. He clearly made a tactical error, maybe going to Washington at this moment in time, John. But I don't think. Do we have a well thought out economic policy that is going to be announced this afternoon? This was a government that came in promising massive supply side reform. It has not been able to deliver that growth agenda. Now what? It doesn't have a mandate for anything, and we are unlikely to see a clearly well thought out plan this afternoon. They will not dare, John, to do anything that is going to expose them to the danger of the OBR saying that this is problematic. They are not going to go anywhere near that. But I'm not expecting a kind of clearly sort of coherent, well thought out plan this afternoon. Be interested to know who's going to be the new Chancellor of the Exchequer there, if we are to get one.
I'm not sure who wants to be the Chancellor in this government right now, Guy. This party is doing terrible.